All right, so let's start. Welcome to the first lesson of our portfolio management. Um, so just we'll start with some, administrative stuff. Maybe I'll just do a short introduction about myself. So I'm Drew. I'm actually based in Canada. So it's like morning here. It's I'm 13 hours behind you, so it's 6 a.m. here. So yeah, that's why I'm in a jacket. And if you notice, after a while, the background will turn bright because it's transition to day. But yeah, welcome to my class. So background, I've been in a corporate investment bank in Singapore, in a French corporate investment bank in Singapore for close to 6 years. And then I actually moved to Canada. I'm in Montreal. So if anyone ever comes here, do say hi. So I'm in Montreal to do my PhD, and then now I'm working in Canada uh, in another French investment bank. So that's a bit of my background. Just a quick kind of uh, survey, right? Is everyone here like at least year 2 or year 3? Any like year 1s here in this course? Because this, I understand, is a more advanced course. Um, is everyone year 2 or year 3? Yeah. Okay, that's good. Yeah, year 3. Okay, that's good. No year ones, any year ones? Because sometimes I know the last few time I thought usually there's like maybe 1 or 2 year ones. Um, okay, so far I think none. The reason why I'm asking is because a lot of the concepts that we're going to tackle this time in this course built on to what you have learned in year 1, particularly year 1. I think year 2 it's still all right. If you're year 2, it's fine. Especially things like financial management, which is your 203 course, as well as other like equity valuation course that we take usually in year 2 onwards. So it'll be useful as well. And I guess presumably everyone's a mix, right? Not everyone's like from the pure finance track, right? Do we have other people from like HR or supply chain, etc. in this group? Or most of you are in the finance or interested in finance in general? From accounting. Oh, okay. We have from accountancy. That's nice. I did my bachelor's in accounting as well, and then later I moved on to finance. Yeah, but accounting is amazing. Um, Definitely. If you are not even in a group now, you want to be taken into a group, or like everyone will want to take you in a group, because yeah, we will do quite a bit of financial statement analysis, or some form of financial statement analysis usually has to be done. Okay, anyway, so the main aim of the course, right, is that at the end of the day, we want to focus on a very broad concept where if you are a portfolio manager, or if you are I wouldn't say investment banker, but more of like a private banker, right? How will you advise your client portfolio? How will you construct their portfolio? So that's the objective of the course. So everything that we discuss, I'll try to link back to, okay, so now if you're in the position of a manager, portfolio manager, what will you do? Or what should you think about? So these are the things that we'll discuss along the way as we progress in the course. And in today's lecture, the main focus would be on the first point, which is the investment policy statement here. Okay. So there are some course readings. There's a study guide for those that want more information. But however, I would say that if you notice, there are 2 sets of notes. So there's the notes that are in the main lecture site, the L1 site, and then there's the T03, which is our site. So if you use the notes that I've uploaded in T03, right, let me know if anyone unable to find the notes. But if you use that set of notes, basically, you'll notice that the number of pages is a lot more. And basically what I have done is I've included a lot of information that is only found in the study guide into the lecture slides. So normally, if you join other classes, what happens is that you have to supplement your slides with the study guide. But what I've done is to really put all the information that you require in the lecture notes. So you don't have to toggle between the lecture slides and then the study guide. So that's kind of my approach. So if you do compare with your other classmates in other classes, you'll notice like, wow, how come your slides are like 100 slides and then their slides are like 10 or 20 slides. So you will see a difference, but don't worry, like all the content that is required in the study guide is covered in the lecture notes. So if you see the difference in number of slides, that's the reason why, right? So this is the course reading. There's a textbook as well. However, the textbook is not really mandatory unless you need some references. Okay, in terms of assignments, I guess this is the second term that we're doing this where there is no pre-course assessment, the usual pre-course assessment. Most of you all being year 3, year 2, you know that previously there was a pre-course assessment. So now there isn't. So we just have a TMA, which actually is only 10%, so not very heavy because it only covers the first 2 units. And then we have the GBA, which is actually the biggest component, biggest component of your continuous assessment, which is 25%. And you will see that the GBA kind of question is a case-based question, which is why at the end of the day, this course is trying to teach you how to put yourself in a portfolio manager shoe and then give you a lot of information based on like a case, or even eventually if you become or you are interested in portfolio management, you have a client and they give you a lot of information, and basically your job is to dissect the information and try to structure a portfolio of your client. So that's what you will see in your GPA as well, right? So all the tools that we're going to talk about in the next few lectures will work towards this more towards this GPA. And then if you notice, your class participation is 15%. So usually I like to be very upright with my classes, that given the evening class, nobody would get a 0 for class participation. Because for evening classes, I think most of you probably know about this, that attendance is actually not non-mandatory, meaning that you don't have to come, and we won't penalize your class participation. So basically, everyone usually gets 50%. Now, if you want to get the other 50%, that's where you participate in class. So yeah, so I encourage you to either unmute yourself if you want. I'm happy to have a discussion. If not, feel free to just type on the group chat, right? And so all this will add up to your class participation. So yeah, again, I like to say, like, I would like to be very upright that if you on how you can actually score on this component, because 15%, which is substantial, and then you have your written exam as well. And I think more details on this will come out, but from previous semester, usually it's open book. Okay, I think we have a question. The study guide is able to send us. No. So it's only even for me, it's only the vital source bookshelf. Yeah, I don't have I have a PDF version of the study guide. However, that's the old one. So the latest one, which is updated with all the information, and then because we did some reshuffling of the content, so the latest one is in the vital source. But if you want the old one, I can send it to you. But I want to caution you that old one is not updated. I think it's to prevent people from sharing the study guide, like to other universities and stuff like that. So maybe some proprietary thing. All right. So the structure of the lecture would be like this. So we have 3 hours. Usually I like to do 1 hour. At every hour we have a break. So we have 2 breaks in between. I feel that usually that's better. I hope it's okay for all of you as well. So we do 2 breaks in between, maybe like a 7 minutes or 10 minutes break in between the 1 hour slots, so that we can rest and then continue the lesson. All right. Okay, regarding the GBA as well, I think most of you have probably seen the message or notification that you have to form your GBA groups by the end of this lesson. So feel free to either drop me a message or email. So either using the Canvas to drop me a message or email on your GBA group. So those that have sent to me already, I have kind of acknowledged that I received. And then if you are unable to find a group member, you don't know anyone, do not worry. I'll just put you in random groups, right? So all of y'all should have a group. And as probably year 3, year 2, you all know that as soon as possible, try to reach out to your group. Make sure they are in the program, because people usually drop out here and there if they feel that the course doesn't meet their requirements or their needs. So feel free to quickly reach out to your group mates, make sure they are there, and then if there are any issues, do let me know, and then we can see how to shuffle the groups here and there. But if you want to choose your own groups, just drop me an email, right? If not, we'll just have a random selection. Yeah, yeah. So those that have emailed, I've received it. Yeah, yeah. During the breaks, you can do a shout out for joining groups. So do not worry. We'll have 2 breaks later. Okay. So like I mentioned, I'd like to usually give a very broad bird's eye view on what you're covering first before we jump into the details, right? Because once we go into details, things can get quite complicated or very detailed, especially in this course. So couple of things to highlight. There are a few, especially on lecture 1 and lecture 2, there are a few so-called self-reading component of the course. So later I'll point them out, as well as a pre-recorded lecture because of how heavy the course is. So hope it doesn't scare you, but I'll highlight again at the end of this lecture after what we've discussed. All right. So in today's lecture, we're covering the main thing that I would like to cover is this thing called the investment policy statement. So this is the main thing that we'll cover. And as a kind of layman term, right? So let's not go to the detail of what it is first, but in layman terms, basically it is a document, almost like a reference document, like a study guide that guides the portfolio manager on what to do, right? So in layman terms, what's the IPS? You'll hear this term investment policy statement. Basically, what it means is that it is a document that will just guide portfolio manager, right? And so the idea of today's course or today's lecture is how do you draft the IPS, right? What should you write inside? Should you write this? Should you write that? There's so many things you can write, right? Should you write everything that your clients say? No, right? So we are focused on what should you write in your IPS, and there's actually a lot of considerations when you write the IPS, and we'll kind of understand this in detail. Before I move on, any questions regarding the assessment, regarding the structure of the lecture, any proposal if you prefer 1 break instead, and or you want to have 2 breaks or 3 breaks, do let me know. Or everyone's good so far. By the way, today is -20 here in Montreal. It's really cold. All right, so I guess everyone's okay. All right, so I guess it's fine. Okay, so now let's jump into the content of today's lecture. So what is portfolio management? And of course, feel free to stop me if you have any questions along the way. So the idea of portfolio management is that, you have a client and the client has various needs, right? He wants maybe 10% return, but he's very risk adverse. He has a lot of criteria, or maybe he only wants you to invest in green stocks, ESG stocks. So things like this. So there are a lot of criteria. And as a portfolio manager, what you have to do is to, first of all, do the planning phase, right? We'll talk about planning. So when we talk about planning, we want to formulate, the investment policies, which is the IPS that I talk about, like this reference document, right? Of course, before as the process go, you also need to determine, okay, what is the capital market expectation? Meaning what? Like, what is the market? How's the market now? Is it in a recessionary phase? Is it on the upwards picked up, or are people very conservative now? They want to save more. So what is the economy like? So you have to determine that. And we'll look into this as well. We'll talk about a bit of economic kind of policies and then things that will impact your capital market expectation. And of course, we have your things of strategic asset allocation. So how do you allocate your assets, right? When we talk about assets, it's not we don't only talk about things like stocks and bonds, which you are thinking all of you are familiar with. We talk about things like real estate, right? Should you consider real estate in your portfolio? And we think about things like fixed deposit, which is quite common, or even things like human capital, right? So we don't even consider like monetary items. We consider things like human capital. Should you consider human capital as part of your portfolio? And yes, then how do you do it? Right? So in this course, we'll discover these kind of things. Besides the traditional assets, which yes, is important, but we need to consider other aspects as well. And in aggregate, that consists of your portfolio, right? And so this is the planning phase, and then we have your execution phase, where you actually execute your portfolio. And you do this thing called tactical asset allocation. Just wondering, anyone know what's the difference between strategic and tactical? Like, or are they exactly the same? Anyone knows about this? What's the difference between strategic and tactical asset allocation? So you can simply unmute yourself or you can type in the group chat. Or you're not sure, you can just say you're not sure as well, and then we can go through. Not sure. Okay, no worries. Yeah. So the difference, which I'll point out again later, when we tackle this specific topic. Yes. Oh, nice. That's great. Someone knows. Yeah. So you are right. Strategic is more passive. Tactical is more active. That's true. So strategic is almost like when you first create a portfolio, you do a strategic kind of asset allocation. So this can be very in-depth kind of research, and then you set the allocation of assets, right? Now, tactical is almost like the word, what the word means, like tactics, right? In a sense, you are tackling something. Like, for example, suddenly maybe like we have last year we have a few bank collapse, right? I think most of you all are aware of that. If you have been reading the news and all, so you know that there are some bank collapse, and it has impacted, of course, the economy. And so because of that, it might actually impact how you actually allocate your assets, right? Maybe you want to shift away from the financial stocks or financial kind of offerings. So those are called tactical. So they are more active. You have to respond to something. That's why you have a tactical kind of allocation. And remember, when we talk about portfolio management, we bring in a lot of human aspect as well, because at the end of the day, you're working with a client. So we need to consider things like, what if the client's you know relative, or not relative, parents pass away, right? Someone pass away, and suddenly you need the funds, you need the money, right? So then you need to suddenly change your asset allocation to be to suit your client's needs. So this is kind of like a tactical asset allocation, right? So that's the difference between strategic and tactical. And last but not least, we have some feedback in terms of portfolio monitoring. So this part is usually a bit technical. You'll see that we do a lot of calculations. We do some statistic kind of like way to point out whether the portfolio is actually gaining value based on the passiveness of your portfolio manager, or is it gaining value based on his active trading? So we'll do quite a bit of number crunching in this last aspect, which we'll cover in the last two lectures. Okay. Please explain a portfolio, you see, but yeah, for sure. Always like to cover, I try to explain it in like a very layman term. So a portfolio. So what is a portfolio first? So basically, a portfolio is imagine like a bowl, right? A big bowl. It's almost like your rojak or like a salad. So you're basically, a portfolio is things that you put inside a salad to make a salad or to make a rojak, right? So a portfolio consists of various financial or non-financial products that you put inside a bowl or document, and then this consists of 100% like a pie, right? It consists 100% of your, I would say, your net worth, 100% of your net worth inside in this portfolio. And then it can consist of things like stocks, bonds, treasury bills, fixed deposit, but we also consider things like human capital, we take your real estate, we consider things like your job, what is your job security like, what is your pension. So you will see that we consider a lot of things in part of portfolio. So it's almost like everything, almost like your net worth, but it does not only include investment products. So that's something that I want to drive to all of you. It does not only include stocks and bonds, because we are going to consider a lot of other aspects. And this, in the simple terms, is your portfolio. So everything that you put together that is considered, and you want to pass it to your portfolio manager to manage for you, right? So that's your portfolio, almost like a bowl with all your aspects of things that you want to consider. Hope that's clear. And so we go through the 3-stage planning, execution, and feedback. And it is a continuous process here, right? So just now we mentioned, we have to consider the what's the capital market kind of situation, and then you assess, things like political, social, sector, etc. You form an expectation, and then you talk to your clients, right? Your clients have some objective constraints, and then you form a IPS. So this is your IPS. This is the main thing that we're going to talk about today here. This component of the portfolio management. This one, we'll talk in, I think, lecture 2. And then here we'll talk about in lecture 3. Lecture 4 is 4, 5 and 6. 5 and 6. Something around that, right? There are some spillovers as well. So yeah, but it's more or less like this. Okay, so a bit more details about each step. And again, I want to highlight that you see all these details, right? At the end of the day, you don't need to memorize any of this. It's really about more understanding it, because how questions will come out is about like case in your GPA or like short case, right? So GPA, if you have read through already, it's like really long case, but even your finals, it can be short case, and then they'll try to test you whether you understand the concept of or the concept that we talk about. So like things like this, of course, you don't have to memorize. It's really about understanding. Feel free to ask questions as well along the way as we go through these few points. So planning phase, it's the IPS that we are talking about. And we'll go into detail about this IPS. Basically, it's a document that consists all the information that guides the portfolio manager. Okay, so it's a document that guides the portfolio manager. It's like a fancy way of like a guidebook. Okay, we form some capital market expectations for long run. Of course, in order to form this or to write this guide, you need to have some market expectations, right? And then you determine the strategic asset allocation. So these two components will be covered in lecture 2. So we won't talk about this time. Now, execution phase, there are quite a few considerations when we execute a portfolio. So what does execute a portfolio mean? It means that you start to really build the portfolio. So let's say in your IPS, the IPS say, I want 40% Google stocks, 20% bonds, UK bonds, all right? So now if you say 40% Google stocks, so now you need to buy the Google stocks, right? So this is execution phase. So your execution of buying the Google stocks, buying the bonds, UK bonds, let's say, are all part of execution. And the speed of execution, cost of execution, all plays a role now, right? So how fast do you execute? Is it very costly to buy all these products? So these are things that we need to consider execution phase. Of course, when you execute your portfolio, it also means that selling the things, selling the products, right? For example, let's say you have a crisis or your client has a crisis. He needs money now, right? So he needs like maybe 1 million now. So how can you actually, does his portfolio consist of liquid stocks or not liquid stocks, liquid products, right? That he can sell? Or are they things like very illiquid, like real estate? Of course, you can't sell the real estate or your let's say your house tomorrow. You can't do that, right? It takes months to sell. So these are very illiquid. So things like this will impact, how well you can manage your client, or whether you are a good portfolio manager or you are a bad portfolio manager, right? So these are things that you need to consider in the execution phase. Yeah, of course, if your portfolio consists of a lot of illiquid assets, transaction costs can be very high, right? If you want to quickly sell it within a month, of course, you try to sell it at a fire sale. Maybe you don't get the best price, you lose a lot of money, etc. Of course, there are things that we need to consider, like commission to brokers, things like taxes, exchange rate, etc. Things that we need to think about when we do execution. The feedback side of things is, how do you evaluate your portfolio manager? So I do have a question here. If your portfolio manager return is equals to S&P 500. I hope everyone knows S&P 500 return. Is it good? Is he a good portfolio manager, or do you think he's a bad portfolio manager if the return on the portfolio he created for you equals to S&P 500? Good. Okay, we have good and bad. Bad. So we have more bad now. Bad. Okay, okay. I guess, yeah, most people think it's bad. Anyone want to say why? Why this, we can unmute yourself, or even, just type a short sentence on why do you think it's bad? Okay, yeah, that's a good reason. So if your portfolio manager is only getting S&P 500 return, then you might as well just invest yourself, right? You nowadays, with technology, with all your apps, you can just go to Tiger Trade? Is it Tiger Trade? Or what's the other one that was quite popular? So you can just basically buy the product yourself using a ETF, which we'll talk a little about ETF in the next few lectures. But yeah, you can simply buy yourself, and you don't have to pay management fees, right? And you can still get the S&P 500 return. So yeah, it can be considered bad. Of course, then we can think about it as you can say that it depends as well, right? So if the return on the portfolio is equals S&P 500, yeah, fine. S&P 500 are stocks, correct? But what if your portfolio includes things like real estate, includes things like bonds, and in aggregate, yes, you might get S&P 500 return, but your construction of your portfolio is not just purely stocks, which helps you diversify. Okay, then if you think about it in that sense, actually it's not too bad as well. It might be good. So I see somebody say good. So I hope you can be able to understand this. Like, yes, it's only equal S&P 500, but remember S&P 500 are only stocks, and stocks are the most risky product. I hope everyone know, right? Stocks are most risky. Bonds are less, and treasuries are the least risky, right? So if your S&P, if you're taking just S&P 500, yes, it's diversified, but you're still holding stock as a financial instrument, which are the most risky. But what if your portfolio consists of things like treasuries, things like real estate, which help you diversify and still give you S&P 500? Then you're actually taking less risk, but you're still getting S&P 500 return. So in that sense, it's good. Can everyone understand this? I hope you can appreciate the difference, the thing about risk and the returns. Yeah. So in that sense, if there's no question, we continue. So in that sense, right, the feedback is quite important in a portfolio for a portfolio manager. So you see whether it meets the requirements that you want, the risk profile that you want. You check suitability of, let's say, the portfolio strategy, whether there's any need for rebalancing, and this concept of rebalancing is quite important. We'll look at it in the next few lectures. And of course, the portfolio allocation must be purposeful, and if it differs temporarily, we can use a tactical, like what we talk about, tactical asset allocation. But if the change becomes permanent now, then we will have to change the IPS or modify the IPS, right? So then we have to do a new strategic asset allocation. So it really depends on how the environment changes. Is it a permanent change? Is it a kind of there's a temporary change that we just use a tactical asset allocation. This part is also closely related to the part on evaluating your portfolio manager. Is it outperforming, underperforming? How you attribute his performance? Is it because he's very passive? And if he's very passive, then maybe you just invest yourself. You don't need him, right? And how you appraise your portfolio manager. So we look at these details as well. Okay, so there are some change of circumstances like we discussed earlier, maybe a death of a spouse, maybe termination of pension plan that will impact your IPS. And so we'll need to do a amendment to IPS, right? Basically, remember IPS is like your guidebook for a portfolio manager. You need to amend the guidebook so that he will change his approach on helping you invest. Okay. So we talk about tactical and strategic. So tactical is just a short-term kind of response of changing the asset allocation. Last but not least, of course, you have a performance evaluation. I think some of you already started working, you know that this is always part of your year-end bonus evaluation, etc. So those that have already started working know that this is just part of the process as well. Similarly, for portfolio manager, you need to evaluate his performance, right? So manager tells us, how the portfolio performs, and then usually we reference the performance of portfolio to a reference portfolio. So later, I think in the later lectures, lecture 4 and 5, we'll look at how we construct a reference portfolio, how we're going to reference the portfolio that the portfolio manager is handling. Attribution, basically, what is the source of the returns of the portfolio? We'll look at that. Appraisal, of course, so a part of appraisal, right, is whether the portfolio manager is meeting the requirements that is stated in IPS. So this part about appraisal, I have a quick question. Let's say your IPS says that the portfolio should give you 10% return, but now your portfolio manager say, hey, you know what? I managed to get you 15% return, 5% extra. Is this 5% extra good, or is it actually bad? Anyone knows? And of course, why? So I repeat again, your IPS says that you require 10% return, right? You drafted IPS with your portfolio manager. Wow, we talk about it for months, 10% return. Now your portfolio manager say, hey, you know what? After 1 year, it's like, hey, you know what? I managed to give you 15% return, 5% extra. Is this good or bad? Good. Okay. Yep. Good. Yep. So good after deducting management fee. Okay. Yeah. But if it's 15% after management fee, then I guess it's okay. Yeah. Can be good, can be bad. Oh, okay. I like the answer. Depends on risk exposure. That's very good. And I like this is the part that I like you all to think about. And I'm glad you there's this answer here, because you know why? Remember, when you think about maybe it's not very emphasized in the last in other courses, but maybe somewhere along the way, I hope you will appreciate that as you get more returns, you get more risk, right? Risk and returns are proportional. The more risk you take, the more returns you get. As of everything, even your job, even maybe like, oh, I want to move abroad, right? Moving abroad is a risky thing, right? But perhaps there's more returns, right? So the idea that I want to drive to all of you all is that the more return you get, the more risk you're taking, right? So if your client tell you, I want 10% return, it means that he only wants to take the risk amount that equals to 10%, right? Maybe he's risk adverse. He doesn't want to take so much risk. And so as a portfolio manager, if you give him 15% return, basically your appraisal will be bad, right? Your appraisal will be bad and perhaps will be fired. The reason why is because you're actually taking more risk that your client is willing to take to get these higher returns. So I hope you all can understand that the IPS, right, is almost like a like almost like a Bible, I would to put it that way. Like you have to, as a portfolio manager, you have to follow the IPS strictly. It's not like, oh, I get more for a client, the client should be more happy. But no, you're taking more risk, and the client will be upset because you're taking more risk, and perhaps you'll lose your job as a portfolio manager. All right. So I hope everyone can appreciate this. Risk and returns are proportionate. So IPS stands for Investment Policy Statement. Is in the first few slides. And it's basically a reference guide for your portfolio manager, which is what we're going to draft or learn how to draft. Okay, there are different types of portfolio management, passive, active, and semi-active. Of course, if you are a passive portfolio manager, basically you lose your job. There's no point to have you, right? Because you are passive. So all portfolio managers are active or semi-active, right? If you are a passive, we don't need a portfolio manager if you want to be passive. All right. So it's either active or semi-active. Now, what does IPS stand for? So here you go. Investment policy statement. Again, I want to repeat that investment policy statement, right, in layman terms, is just a guidebook for a portfolio manager. And of course, because every individual or every client is different, is unique, that's why we have to draft this guidebook for a portfolio manager for every single client that you have. So that's what we're going to do now, right? Now, in any portfolio management scenario, it can either be a case study or eventually, if you're interested in portfolio management, you go into the job of portfolio management in every aspect of either a case or real life, you have to draft the IPS. Okay, so I repeat again, you have to draft IPS. So I hope that, when you eventually tackle things like your GBA, or if you see a case or anything, you have to do IPS, even though they don't say do an IPS, but you have to do an IPS. Okay, why? Because it's a guidebook for a portfolio manager. So most of the time, a case or even in real life, you need the IPS to guide you in terms of what you're going to do. And so this lecture one IPS is extremely important because it's like a mandatory step that you have to take before even talking about all the things that we're going to talk in lecture 2 to lecture 6, right? So IPS is mandatory. So I want to repeat. And why I say this is because like in the last few times that this course was being taught, usually this component in like a case is not specified, but it consists of 25% of your marks. But there are groups that just don't write anything about IPS and they just lost 25% of marks. It's not usually not written, but it's mandatory because this is a guidebook. If you don't have a guidebook for a portfolio manager, how are you going to make any decisions, right? So this is mandatory. All right. So, and every component is so mandatory. So we'll talk about 3 components here. One, return objective, risk tolerance, investment constraints, and then we talk about investment constraints. We have to discuss all 1, 2, 3, 5 aspects: liquidity, time horizon, tax consideration, legal regulation, and unique circumstances. That's a good thing. That's a good question. So the IPS is actually for both. Okay, it's mainly for portfolio manager, right? So because your portfolio manager is going to manage your money, right? Your assets. Now, but at the same time, it actually protects the client and the portfolio manager. That's a very good question. It protects both parties. Why? Let's say your statement, you draft an investment policy statement. Let's talk about returns. Okay, your IPS says 10% returns. But however, maybe along the way, something happened, right? The client so-called pass away, and the kid comes in to take over a portfolio. And then he suddenly makes a big fuss, like, hey, you know what? How can you just get 10% return? That's equal to S&P 500. I might as well do it myself. Who says you can just get 10%? How come you're not getting 15% returns? So there's some dispute happening, right? Because your main client passed away and the kid's taking over. So your IPS basically protects the portfolio manager as well. So it helps the portfolio manager as well as it helps to justify like, hey, you know what? Actually, at the point of time when I discussed this statement with the original client, he just said 10%. He asked me not to take more than 10% risk, 10% return kind of risk, right? So it is actually for the client and the portfolio manager. And for the client, it can be like, oh, you know what? The portfolio, the IPS says that I want the maximum exposure to real estate is 2%, right? You don't want any exposure to real estate because it's very illiquid. It's like you can't sell it basically. So you want only a 2% exposure to real estate. However, your portfolio manager, because he decides to buy things like ETFs, right? Things that are like a basket of like, let's say stocks, basket of things, basically basket of things, basket of investment products. So sometimes when you buy baskets, right, it can actually include things like real estate inside, like REITs, right? I hope some of you all know REITs. Yeah, everyone's familiar with REITs. RIET, REITs. Yes, okay, that's good. Yeah. So somehow, as a portfolio manager, you bought some REITs, and then it increased your exposure of your real estate to 5%, but you only want 2%. So because of REITs, your portfolio manager has violated the IPS, right? And so as a client, you can actually sue the portfolio manager, or you can fire a portfolio manager if you're unhappy because of this. So can you see that actually is both for the clients, the IPS is for the clients and for the portfolio manager. And that's why when I covered this slide, I emphasize that it is mandatory, it's a must to write this IPS. Okay. And yes, don't worry, those that are not too familiar with REITs, we will cover REITs as well in your asset allocation component. We'll discuss some stuff about REITs. Okay, so this is just the explanation. I'll not go through. You can read through yourself, basically, things that you have to do. So these are the pointers, and then this is the description. All right, so I'll not go through this. Key elements, we have to think about the clients, what's the purpose, your duty, things like statement, just can just read through, nothing too important. So why is IPS important? So it is for both the client and portfolio manager. It guides the portfolio manager so that he knows what's the client profile, what is his objective, what is his constraints, help the portfolio manager make decisions, right? There are some like, and when we talk about strategic kind of asset allocation or some tactical asset allocation strategies, providing some guidelines, rebalancing, also communication, as well as some regulatory requirements that's required in the IPS. Okay, so now what we're doing is we're going to cover every aspect of the IPS, which should be covered whenever you write an IPS, right? So you need to cover all of these components in IPS. So first of all, usually most important that people will look at is the return. So how much is your portfolio going to return to you? Okay, so return can also be very tricky. Are you talking about absolute return? Are you talking about relative return? What kind of return are you talking about? Total? Is it nominal or real, or pre-tax, post-tax? So there are things that need to be specified in terms of return. So you need to be very specific when you think about return. Okay, so again, I want to repeat that the bird's eye view, or the so-called broad-based concept here now we're tackling is how do you actually draft the IPS, and these are the components of or things that I hope would trigger you to think on to consider when you draft the IPS. So you don't have to tackle every aspect of this, but there are considerations that you should consider when you draft the IPS. And in this component is the return objective. Okay, so we need to think about desired and required. What's the difference? We'll look at it in the next slide. Whether is it sufficient to meet the spending needs and the wealth objective, right? So now we have a client. If his yearly expenses is let's say yearly expenses 500K, right? He needs 500K per year to live. So your portfolio should at least give him 500K per year, right? So this is his spending requirements. And maybe at the end of the day, he wants to pass on 1 million to his kid. So that is his wealth objective, right? What does he want to achieve at the end of the portfolio? Okay. You need to consider risk. This is very important. That's what I hope managed to highlight to all of you all, that risk and returns are proportionate and related. Okay, not really proportional, but related, right? And so when you take a more risk, you get more returns. Must be specific and measurable, achievable, realistic. Of course, it must be realistic based on the market expectation, right? So if we are in a recession, which I'm glad we avoided a recession, but if we are in a recession, can you ask a portfolio manager to get 20% return? No, that's not fair. It's not realistic. The portfolio manager will never be able to do that, right? Because we're in a recession phase. So we need to consider things like market expectation. Of course, the time horizon will impact your risk. So later we'll discuss quite a lot on what actually impacts the risk, right? Okay, so going to types of returns, inflation, we need to consider inflation, especially why we need to consider inflation. Anyone knows why? Why not we just don't care about inflation? Why do we need to consider inflation in our portfolio management? Time value of money, okay, yeah, that makes sense. Yeah, it erodes your real your return because clients interest in real. That makes sense. And one of the main thing, okay, I like the comment on time value of money. Why? Because remember, portfolio management, right, can be many years. So most of the time when client approach the portfolio manager, they're not looking for a 1 year portfolio management kind of job, right? Usually a portfolio manager manage the portfolio for 20 years, 30 years, 50 years. And even nowadays, right, it's very common to do multi-generational portfolio management. Means what? It means that the portfolio manager doesn't manage yes, he manage the client's money, but he manage the client's son assets. So it's multi-generational. And because of that, when the time horizon is long, inflation becomes a big impact, right? It erodes, like what y'all says, right? What y'all say, right? Erodes the returns. So we need to consider inflation. Nominal is most of you I will understand. Nominal is just how much real includes the purchasing power, right? So it erodes away the returns that you have. Post and pre-tax, this is important because tax is a big factor that impacts your returns at the end of the day because it's being taxed and removed away. And we'll discuss tax in quite a bit of detail. It's quite interesting. All right, so have everyone seen this thing called the Fisher equation? Everyone knows the Fisher equation? Yeah, money depreciate. That's a good comment. Anyone knows what's Fisher equation? Have seen it? Have heard of it? No? Oh no. Okay, I thought year 3, I hope. Yeah, this should be covered in year 1 or something, like heard before. Okay, not sure. Uh okay, so maybe you have to those that are not so sure, we can brush up a bit on the Fisher equation. But basically, what is the Fisher equation? In layman terms, right? The Fisher equation is the equation that relates nominal rate with real rates, right? And so we just now already discussed what's the difference between nominal and real. So nominal is the actual rate, real is you adjust it for inflation. So in this point, right, I want to highlight to you something. If inflation I equals to 4%, okay, very high inflation, that's very high inflation. Your nominal, just RNOM equals to, let's say you have a 10% nominal return, right? So I want to highlight to you that you cannot take 10% minus 4% equals to real, because 6% real. This this method here is wrong. You cannot just take nominal 10% minus 4%. No, this is wrong. I hope none of y'all will do this, but don't ever do this. You have to use the Fisher equation. So you just plug in the values here. Okay. And we have an example in a bit to show you how to use it. So if you are looking at nominal cash flow, discount it by nominal rate, real cash flow, discount it by real rate. Okay. Okay. So now we have an example here. Okay, so we have to consider pre-post tax as well. And then we have an example here using the real, inflation and tax as well. So let's look at what's happening here. Suppose the real post-tax return requirement is this, right? So it's real and post-tax, so after tax. The interest rate is tax rate is 25%, inflation is 5%. What is the nominal pre? So nominal pre, so method one is incorrect. So what's happening in method one? So method one, what do? You convert the post to pre first. Can you see? That means you adjust for tax first. And then after that, you adjust for real to nominal. Now, this is not correct. Why? Remember that you must work backwards. So what happens is that in your financial statement, what happens is you have your gross profit, then you have your tax, then you have net profit. Then after your net profit, then you change your net profit into the real profit, so called. So the order of your implementation should be tax, then convert to real, right? So when you reverse, because now they're asking you to go back to nominal pre-tax, right? So when you reverse, you need to go backwards as well. Meaning what? You have to convert into nominal first, which is what is being done in method 2, nominal. And I'm using the Fisher equation. I hope you realize that. Then you go back to pre-tax. So you do inflation, then you do tax. So this is the correct method. Okay. I just want to highlight this because sometimes you will see some questions and he's like, oh no, which one should I do? Should I do inflation? Should I do tax first? Always, if you are working back to nominal, always work on converting the inflation, then convert the tax. Any questions here? Okay. All right, so we do have a small case, right? Like a small case that we have it here. As I mentioned, this module is mostly case. So Susan is a president of this company. She's 58 years old. She has no immediate family. Okay, that's a bit concerning, but let's see. Expects to retire at 65. Her pre-tax base salary is 500 a year, 500K a year. It is just sufficient to support her present lifestyle, right? She has 2 million in savings from prior year, which she believes she can invest in an annual after-tax total return of 3%. Sorry, 3% until she retires. So she owns some stocks as well. Okay, expect to sell it for 10 million upon retirement and subject to tax. So the sales of the stocks will be subject to tax. Her present level of spending and current annual inflation is 4%. She has a tax 35% of all salaries, investment incomes, and capital. So everything is being taxed. So what is her annual after tax real? So you need after tax and real requirement during the retirement. So I've put in all the workings, so it's easier for those who have to copy. And the main thing is I hope you understand how to do it, right? So if you have any questions, do stop me. So first of all, we look at converting, because we are given the inflation, and we know the total after-tax total return of 3% is required, right? So these are nominal. So we want to convert, we want to have it in a nominal post-tax return. So we use the Fisher equation here. We get it. There's approximation here. You can not approximate, you just calculate it, it's fine. You don't have to do approximation, right? So once you get your nominal post-tax return, we know that she's going to retire in 7 years, right? Because she's 58 now and she's going to retire at 65. Okay, so we know that she has a 2 million saving, right? She has a 2 million saving. And so she has 7 years to actually grow this saving at the nominal rate, right? At the nominal post-tax rate, which is what's given here, right? The 7% that we calculated. Okay, because your money is in nominal sense, right? So remember earlier we talked about slide, if it's a nominal cash flow, you must discount or compound it at nominal. So that's why we need to calculate nominal. We cannot use the real rate to calculate. Yeah, everyone clears that? So when you have a nominal cash flow, you need to use nominal rate. So that's why we are calculating using nominal. Okay, our investment asset. So now we know that this is her savings, and then she has a 10 million in stocks, right? But she's going to sell at retirement and it's going to be taxed at 35%. So we need to include tax here. Now, she mentioned that her spending is 500K and it's just sufficient for her requirements. And so we need to determine how much is actually required after 7 years when we consider inflation. So we do inflation and we need to consider the tax as well, right? And so we realize, oh, okay, her annual spending will be this in 7 years. And so we just take her spending, right? Her spending here, divided by what's her assets that she has. And that's how we get our after-tax real requirements after retirement. I'll just pause here for a while. Any questions? No. So in case I'm going too fast or so, feel free to stop me, ask me to, okay, now can we repeat this concept? Can we go a bit slower as we go along? Okay. Okay, so return objective, now that we are done with the calculation, let's think about required and desired. So that's a good question. Yes, so it has a lot of calculation. So you will see that it's not a pure, okay, so this module is quite interesting. It's a very 50-50. So 50% is calculation, 50% is writing. So if you notice, right, what we covered is that it's a very combination of both, right? When we talk about return objective, right? We think about things like inflation, and these are things that we need to calculate, right? However, now we're going to talk about things like what is required return, what's desired return. And this component of required, desired is actually more of like written stuff that you need to write, you need to explain, you need to justify. So it's really 50-50 of both. And in case you are worried about the calculations, I usually try to make it as simple or try to explain it as simple as possible, even though sometimes the concepts can be a bit tricky. But yes, there's quite a bit of calculation. So 50-50, I would say. Yeah. So do not hesitate, to stop and to ask questions if you are confused at any point in time. Okay, so for return objective, we have required and desired returns. And so the distinction is important, right? Required is basically necessary. You need these returns, right, to survive. Now, desired can be additional, or because your client wants to buy a house at 65, right? She wants to upgrade to a new house. So these are desires that she wants. But does she need a new house? No, maybe she already has a house, right? So these are desired returns. So things that you need to consider. Required, what is required, what's desired. So when you read a case, when you have a client, you need to determine, is this a requirement or is this a desire, right? it's very similar to managing your own money. So actually, at the end of the day, if you think about it, all of you are portfolio managers because you are managing your own portfolio of assets including your savings, including your pension like your CPF, and even your assets like your real estates, right? Like if you are living, if you have a house, you have a HDB, all these are part of your assets. So all of you are actually portfolio managers. So the reason why I like this module a lot because it's very applicable to your life. Okay, so if so this is just a comment. If the investor's return objective cannot be met, is violating the portfolio, the IPS, right? So you need to, of course, as a portfolio manager, if you promise your client in the IPS that you will get 10% return, and you somehow only can get 5%, you are violating his requirements, you will be fired, right? So that's why your portfolio managers can be fired because he's not meeting the return objective that has been set up in the IPS. So again, I want to emphasize IPS is super important. It really dictates a lot of things, right? It dictates things like whether your portfolio manager will still have his job. Okay, so before we move on to risk objective, let's take a break, maybe like take a 6 minutes break. We're back at, or 7 minutes break, we're back at 7:11. Yeah, we'll be back at 7:11. Before we move on to risk objective, is the second component of IPS. In the meantime, quick reminder, send me your GBA groups, or if you do not have a groups now, feel free to use the time to form groups, and we'll be back at 7:11. If you have any questions, feel free to write in a group chat as well. All right, welcome back. Hope you guys have a short break, have some coffee. Um, all right, so let's continue on the second component of the IPS. So the first component we talk about is the return objective. Now, of course, like when we first start the lecture, right? We talk about where give a question regarding returns. There's always the component of risk that we need to consider. So now let's think about the risk objective. Okay, so risk again you can measure based on absolute terms or relative terms. And what does it mean is given here, right? Relative, it can be relative to the S&P 500, which is almost like your diversified portfolio consideration, or it can be absolute, right? As given here. So when we think about risk, you need to consider two components, willingness and ability, okay, to take risks. So whenever you talk about risk, okay, in IPS, you must, I want to emphasize must, talk about these two things, willingness and ability. It's a must. So if you write the IPS and you just talk about willingness, oh, the client is willing to take risks, you will not get the full marks, okay? You will just get half the marks because you will miss out ability. Yes, the client is willing to take a risk, but can he take the risk? Is he able to take the risk? So this is the part that we need to consider. So both willingness and ability to take risk will contribute to your risk tolerance of your clients. So there is this simple table that you can see here. And in your explanation, when you write your answers for case, you need to talk about both components and eventually come out with a risk tolerance level. So how do you read this, right? So if your client's ability to take risk is low, his willingness is low, okay, fine, it's low, right? Now, if his ability is low, but his willingness is high, he wants to take more risk, but his ability is low. Basically, you are, as a conservative portfolio manager, you should categorize him as low risk tolerance because he's not able to take risk. Yes, he wants to take, his ability is low. So, as a conservative portfolio manager, go for the lower one, say that his risk tolerance is low. Now, if his ability to take risk is high, however, his willingness to take risk is low or below average, now there is a conflict already. And as a portfolio manager, it comes your responsibility to explain to your client or try to understand about your client why his willingness to take risk is so low. Okay, and we'll look at a few aspects of your clients that will impact their ability and willingness. We'll look at it in the next few slides, right? And so, as a portfolio manager, you need to dissect the information to understand actually your client. Why is he so unwilling to take risk, even though his ability is high? And by understanding your client, you kind of be able to draft a proper proposal, a proper IPS for your client. Okay. Of course, if the ability is high, willing is high, the risk tolerance is high. Now, let's tackle the first component of risk tolerance, which is the willingness, right? How willing is your client to take risk? So when we think about willingness, and it's a very typical thing. I'm not sure any of y'all have done like this kind of survey thing whenever you want to invest in like Moo or Tiger Trade, sometimes they give you a survey to do, right? And usually this kind of survey is a personality typing. So they're going to try to understand what's your personality type. Are you very aggressive in terms of investing? So your willingness is very high, or are you very conservative kind of investor, your willingness to take risks is low. So they do kind of like personality typing, and this is part and parcel of portfolio management. So in most of the time when you read cases, right, they will not tell you the client has low willingness. They will not say that because it's a case, right? So it's a real life where most of the time they give you like sneak bits of information here and there. So you need to piece together information. And one of the important part is the personality type. So you need to try to understand, okay, from the information provided, what does it tell you about the personality type of this person, right? So you need to dissect the information and get that information. Besides personality factors, this is very important to consider, right? Usually in some kind of case, they'll explain certain situations and how the client responds in the situation. So you need to bring in some psychological kind of bias, and things like, so this is not, so there's a lot of psychological bias. Everyone is aware of this kind of psychological bias. Yeah, everyone knows about this. So, or have seen before this kind of concepts of biasness in trading, in finance, or even daily life. Yeah, no, okay, no, okay, no, oh, okay. So it's the first time seeing psychological bias. Okay, the one person saying no, I guess maybe have. Okay, yes, no. Okay, so mix. So very 50-50. Okay, so for benefit of everybody, right? Psychological bias basically is like things that are not rational, right? So you make decisions that are not rational, but the thing is, why do you make such irrational decision? Because there are some biasness that you have, right? So there are five that are stated here, but I want to highlight to you that these are not exhaustive. Meaning what? There are a lot of it. If you go Google psychological bias in trading, in finance, you see a long list. So feel free to bring in more information that is not in the slides, right? But these are the ones that I want to highlight to you. First of all, loss aversion. So this is the biggest one where you know people feel that they feel the pain of loss more than the rewards of gain. What that means? Imagine if there's a risk to lose 10 million, right? The risk of losing 10 million is so painful to you compared to the rewards of getting 5 million, right? So if you are very conservative, you don't even want to take the risk of the loss component. So this kind of irrationality is loss aversion. Bias expectation is you kind of think like, oh, I have, S&P 500 has been doing so well for the last 5 years, let's just say, right? So your bias is like, oh, because of that, in the next 5 years, it should do well, right? So this is very biased, right? Like, why would why would history repeat itself? There's no reason why, right? So it's bias expectation, asset segregation, where you kind of evaluate the choice of asset individually. Okay, I want to invest in stocks, and then you say I want this stocks, and then I want to invest in bonds and this bonds. So you're not taking a very portfolio, because remember we're doing portfolio management, so we need to consider everything as a portfolio, right? Including things like human capital, right? What is your salary like? These kind of things. Okay. Reference dependence. So you have a reference in mind. For example, oh, maybe your friend say that his portfolio in these stocks has been on an upwards trend, right? So with that reference in mind, you kind of push you to make a decision based on this reference that you have. So this is illogical, right? You should do your own research. You should make sure that whatever your friend is doing, are you sure that you can replicate the same thing, right? And mental accounting, right? Mental accounting is that you have different kind of um, you accounts, right? And then you segregate it and put it in different accounts. Meaning what? What's the best way to kind of explain this is that, oh, if I spend so-called $10 on a movie and I spend $10 on food, both of spending is $10, right? They are the same outflow of money. In a very rational sense, there's no difference, right? However, in a mental accounting sense, because they are in different accounts, one is more like sustenance meaning food you need to survive. One is for like entertainment. There's different levels of priority placed on this cash outflow. So this is there's a bias as well. right? So all these are based on the psychological considerations, which you need to consider when you read cases of your client and see whether their decisions that they make are affected by this kind of psychological considerations or biasness. Okay. So that's one aspect. So remember, talk about personality that affects willingness, psychological kind of consideration of biasness. Next is also source of wealth. This is important. Why? Okay, let's say your client is self-made. So what does this mean? Self-made. Self-made means like you are entrepreneur, you make it big in the market, you get a lot of wealth, right? You become rich. So usually self-made kind of investors are typically high willingness to take risks. They have high risk tolerance because they took the risk, they got the rewards, right, of a self-made investor. They kind of became rich because of the risk that they took. And so generally the tolerance are very high. At the same time, because they're self-made, sometimes there are issues with giving control to the portfolio manager. Because you're self-made, right? You actually gain your wealth yourself. So because of that, you do not want to, why should I trust you? Who says you are better than me, right? Because I made the wealth myself. Who says you help me grow my wealth even more? So because of that, sometimes they have a inability to give control to a portfolio manager. So as a portfolio manager, right, you need to assess this. You need to see your clients. Okay, is he self-made? And if so, you need to tailor kind of the conversations you have with him, the interview you have with him to meet his requirements. So maybe you say, you know what, how about we share control of the portfolio? So you make the final decision, but I craft a portfolio for you, right? As a portfolio manager, I craft a portfolio. However, in the end, if you want to execute it, that's your decision, right? So you give control to him. So this is how you kind of assess his character. However, if it's a passive kind of recipient of wealth, meaning what? Maybe he got gifted a bungalow from his parents when the parents pass away. So the wealth is being transferred to him. When wealth is being transferred to someone, the person generally has very low tolerance for risk. Why? Because his idea is that, hey, I did not make this money myself. It's given to me. And the concept is that usually you want to preserve the wealth. You want to keep the wealth with you. You don't want to risk it on a big portfolio, a very risky portfolio. Yes, you might make 30-50% returns, but this wealth is not yours or was not, you did not make this wealth, and therefore you do not want to risk it, right? So I hope everyone can see that this it kind of like dictates how your client respond to risk. Any questions so far? So that is willingness. And now let's talk about ability to take risks. So willingness is how willing, right? Now ability is really innate. Innate meaning what? It is in you, right? Can you actually take risks? Like, does it make sense for you to take risks, right? So generally, if your client's goal is very big, like he wants, okay, so his portfolio is, let's say, 100,000, but his goal is to get to reach a goal of 1 million at the end of 5 years. Wow, this is so the goal is so big, right? From 100K to 1 million. So because of that, you need to assess the ability. Can he actually take so much risk to reach 1 million? Maybe not, right? Um, so you need to see, of course, also how the portfolios must support his lifestyle, and also need to cover things like estate planning and succession planning issues, especially as the portfolio ages or becomes large. And this is something that's very interesting. We'll discuss it more in the next few slides. So the ability to take risks really is based on things like time horizon. So the longer time horizon you have, the more risk you can take, right? Because if you have a longer time horizon, you can take bigger risks. And even because risk is both upside risk and downside risk, right? Downside risk meaning you lose money. right? So if you have a longer time horizon, you can actually use your upside risk to counterbalance off your downside risk, and eventually your aggregated returns can be quite high, right? So if you have a longer time horizon, you can take more risk. Shorter time horizon, um, lesser risk. And how do you determine time horizon? It's based on age, right? So what's your client age? And when is he going to retire? Like in the last case, remember we had a 7-year time horizon, which is actually very short. So maybe you cannot take on too much risk. However, if you have a 20-year time horizon, then sure, you can take on more risk. So this affects ability. Now, stage of life, this is another aspect of that affects ability. So now we're really getting into the human aspect so it's like less about finance, but at the same time, it's very relevant to the portfolio management, very relevant to understanding risk tolerance of your client. So what stage of life are you in, right? Like for, I think most of your, or even probably even myself, we are in the foundation kind of stages where we are still kind of young. We are maybe most of you are much younger than me. A full-time student. So you are very young. You have a long time horizon. You can actually take on a lot of risks. Your ability is very high. However, usually at this point of life, while theoretically you can assume risk, but many are unable to do so. What does it mean? It means that, hey, you know what, you can take risks, but maybe you don't have liquidity. Okay, maybe if you are gifted some things, right, from your grandfather, maybe you are gifted a apartment. If you're lucky enough, if you are gifted apartment. So yeah, okay, you can stay in an apartment, but you know what? You can't sell your apartment, right? And then you have nowhere to stay. So you because I can't take risk, right? Your risk because of illiquidity of your assets, you can't take risk. So this is the foundation stage. But if you're more of an accumulation stage where you know what, you're actually planning for things like family, having education, healthcare, even buying a home. At this stage of life, if you know your client is this stage of life, you know that there'll be a lot of outflow of money, right? He might need money at a go. So if you realize your client is at this stage of life, maybe you don't want to suggest that his portfolio consists of um, real estate, because real estate is very illiquid, right? So maybe you suggest, hey, you know what? How about we don't put money in real estate, we shift your portfolio, or we tilt. Okay, so we'll discuss more about this idea. Tilting your portfolio into maybe more stock based, or if he really requires money at a go, how about we invest a bit more on fixed deposits, right? Because that one, there is a lock-in period, but we know that we definitely can get the money out if you really need it. So that's how you actually tilt your portfolio asset allocation based on stage of life. So January is too long. The accumulation phase, 30 to 40 years old, still quite long. Maintenance, when maybe you reach 65, if your client is 65 years old or 60 years old, going to 65 when he retires at 65, your idea as a portfolio manager now is, okay, my client is getting old, right? He's going to retire soon. Maybe now I should tilt his portfolio, or suggest that he tilt his portfolio towards more safe products, right? Less risky products, things that that will preserve his wealth, right? So this is to maintain, maybe so that he can have some money. So maybe you invest in things like bonds. I hope I think all of you are familiar with bonds, where you get coupon returns, right? Coupons. So you get not money, but like usually every half a year, you get a coupon, semi-annual coupons, which would help to maintain his lifestyle. Right, he has some money to travel, maybe he has some money to buy stuff. So you want to invest in more coupon-related products, right, or coupon bonds, and maybe not invest in zero coupon bonds, right? Because remember, bonds are different, right? There are coupon bonds, there are treasury bonds, zero coupon bonds, etc. A lot of type of bonds. So risk tolerance begin to decline. you know, you should avoid having he will not be able to recover his loss if you take on too much risk. Um, and the challenge is to ensure desired level of portfolio stability and uh, ensure that it does not have exposure to much risky assets. Options, excellent. Yeah, okay. So I like the topic of options as well, and we'll cover options. Unfortunately, we will not go into the detail of like option pricing and how do we structure options. I'm not sure whether there's a course on that, but that's quite interesting part of options. But the idea of options is actually very good. Um, in a sense that maybe at the maintenance phase, because options, so okay, maybe take a step back. So options are derivative products, right? In case not everyone knows what's options. So options are derivatives. So derivatives generally are taking leverage on your positions. So what do you mean by taking leverage on positions? It means that you are actually taking like a loan, like a fake loan to buy some products, right? And then, of course, if you take a loan, it's risky. You get more returns for your options. So options might not be so relevant at maintenance phase. Maybe when you're younger, like you're at this stage of life, accumulation or foundation stage, yeah, options are quite good products to actually buy into. And that's right, derivatives are also another subset of products that a portfolio manager can um, provide to a client. And we'll understand derivative products, I think, in lecture 3, but more from a risk management perspective, right? So we're not trying to make money off derivative, which you can, and you can make a lot of money based on derivative products, but we'll try to understand more of a risk management. How do we use options to reduce our risk for our clients, right? So, because remember, returns are easy, okay, not very easy, but everyone can make returns, but not everyone can control the risk, right? So that's why in the course, in this course, we really focus a lot on the risk management component of things. Okay. Last but not least, distribution stage. Distribution is where you really need to consider how are you going to transfer your wealth. Okay, so most of us are quite young here. Maybe we haven't even think about how do we transfer wealth. But I want you all to start thinking about things like, you know what? Transferring wealth is not simply about writing a will. Okay, I write a will, finish. That's all. I transfer my wealth to my kids in the future. No. I hope you all can start thinking about things like, you know what? What are the tax considerations of transferring wealth? So I'll give you an example here. For example, you bought a HDB, right? And so maybe your idea is and you have 2 kids. Let's say you have 2 kids. Okay, your idea is that, hey, you know what? I write the will, and I say, when I pass away, my HDB will be given to my 2 kids. Right? Very simple. Split 50-50. Are there any issues with this? Anyone can point out a very big issue with this will that you have written that's supposed to help you transfer wealth? Anyone want to point this out? You can unmute yourself. You can write in a group chat. Oh, perfect. That's a good answer. Yeah. So that's what I'm getting at. A lot of people meaning maybe even my parents or your parents did not really think about this carefully. So yeah, okay, you write a will, and yes, it's divided. The HDB is going to be split 50-50. But the issue that we need to think about as a portfolio manager or even yourself, right, as an individual, is that the HDB needs to be liquidated to divide into two, right? Does it make sense that okay, 50-50, then one children take half the living room, the other children take half the living room? You can't do that, right? So the thing is, eventually what happens is that if you do not plan your distribution well, what happens is, okay, you write this will, and the HDB is eventually given to your 2 kids, but they have to liquidate it. And most of the time, when someone passes away and they need to liquidate things, liquidation is usually it means the product is being sold at a very low price. It's like usually it's below market, so they can quickly sell and get the money. And at that stage where you are trying to sell, you are like so focused on selling, you do not consider things like the market value of your real estate, your valuation, things like your property tax that you pay. So all these things should be considered even before you even write that will, right? As a portfolio manager for your client, you need to consider this. You need to tell your client, you know what? Rather than rather than writing a will for your kids that will split the HDB, how about, okay, so if I'm a portfolio manager, how I recommend my clients that, you know, how about you give your HDB to one of your kids, okay? And then the other kid, what about if you buy a usually I like insurance products, right? So not sure where some of you are insurance agent, but I'm not. But insurance investment products, okay, need to clarify insurance investment products. How about you buy an insurance investment product for your other kid, making sure that both products are similar in value, right? So in your will, write that you give the HDB to one kid and you give your investment product to the other kid. And you settle, right? So that at least one kid gets the HDB, maybe based on certain factors, because he's not married, he doesn't have a place to stay, and the other kid's married with kids and Harry have a place to stay. So you give investment product. So at least in this sense, this is proper distribution of wealth in the sense that your kids do not have to quickly liquidate the HDB to get the money because none of them can stay there. And at the same time, it protects the wealth, right? You think about multi-generational kind of planning. And of course, it also avoids things like property tax when you actually sell your HDB because you need to pay tax, etc. So you can actually kind of avoid certain tax. Let's say that kid that gets the HDB eventually decides to stay in the HDB. Um, and I want to highlight that distribution part of wealth is actually very interesting. There are a lot of ways to distribute wealth in optimal way. So I want to highlight that in this course, we're not teaching you to avoid things like, not teaching you to avoid tax, shifting money into trust and all those things, but we're trying to teach you how to optimize. So that's the proper way to put it. So optimization of your taxes, optimization of your wealth that you might have. Okay, so risk tolerance ability. So as you progress, it might not be linear. It goes back and forth, whether you are in distribution or accumulation based on your personal situation, right? Everyone's different. So this is something for you to read. So you might, go back to the foundation kind of phase in case something happens. So you really need to talk to your portfolio manager in terms of understanding where you are at in terms of the risk ability. So this part here is very important here. I want to highlight to you multi-generational planning. This part is a very small comment, but it's almost what I mentioned earlier about the HDB thing. But however, it is even more than that, right? Multi-generational planning. What does this mean? Um, Anyone has idea about this term, multi-generational planning? So if you notice, I like to bring in a lot of examples, cases to really kind of help you understand the concepts and why these kind of considerations are important. And because most of the time, if you notice, eventually if you are a portfolio manager or when you read cases, right, there are a lot of nuggets of things that you need to consider, nuggets of information. So going back to this question, anyone know what's multi-generational planning? Okay, I guess just use the word. Yeah. Okay. Yeah. 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 Right. No idea. Okay. So yes, planning for multi-generation. So, but the question is, how do you do that, right? How do you plan for? Okay. So it's not really planning about like, oh, I want to have kids. I want to have 3 kids, 4 kids, 5 kids. Yes, it's about wealth transfer. You are getting close. So what happens? Okay. So now imagine you are staying in a place, right? A house, let's say. I use house as an example because everyone needs a house, right? So you have 2 kids, or maybe less 1 kid, it doesn't matter. 2 kids or 1 kid, or 1 kid. So what happens is that, okay, you are already staying in a house, you have fully paid off for your house that you're staying in. Now you have 1 kid. The question is, okay, if you want a larger exposure to real estate, right? Because you talk to your portfolio manager, you say, hey, you know what, I want a larger exposure to real estate, and I want physical real estate. I don't want REITs, right? Okay, so your portfolio manager is like, okay, I can help you get some, I can help you, get investment real estate, right? You buy a, let's say, a condo as an investment. A lot of people do that in Singapore, right? If you want to invest money in real estate, they buy a condo, they sell it, they rent it out, this kind of things, very common. Now, a good portfolio manager will immediately ask you this question. Okay, yeah, or ask you to consider this. Like, yes, okay, you want to buy a condo for investment and rent it out. However, he might recommend, how about you buy it under your kid's name? For example, your kid is already 18 years old, right? So a good portfolio manager will say, wait, don't buy under your name. Why? When you eventually transfer this investment condo to your kid when you pass away, you'll be subjected to a lot of taxes, right? Your transfer tax, your kid must pay property tax, everything. How about you buy under your kid's name, right? So that you are planning ahead for generation. So basically, what happens if you buy under your kid's name, you you are skipping one generation of tax when you transfer the property from your name to your kid's name. You have to pay tax. You basically skip this part about paying tax because it's written in your kid's name. This is under his name. It's his product, right? And then of course, maybe for yourself, because you are a very controlling parent, you feel like, oh, you know what, you don't want your kid to have such wealth at 18 years old. He's still an adolescent. He doesn't know how to control money. So maybe you tell that your portfolio manager, and then as a good portfolio manager, your portfolio manager say, well, oh, you know what, okay, no problem. We put the property under your kid's name. However, we write a legal document to say that the title of the control of the condo remains under you, even though it's under your kid's name. So you work the legal system to ensure that you have control of the condo. However, it's bought under your kid's name, right? So can you see that this is a multi-generational planning where you actually optimize your tax for your portfolio, right? By taking into account where your assets are in your generation, whether it's your generation or your kids' generation. And so you're able to transfer wealth optimally. Everyone understand this point on multi-generational planning? So as a portfolio manager, you need to plan for your clients because your clients might not know about these kind of things, right? Okay, any questions about risk? So now we're done with risk. Remember, risk has two components. You always must talk about risk willingness and risk ability. Okay, so moving on to the next component of the IPS. Remember, we're still talking about IPS. We have so much discussion. So that's why at the start of the module, I always like to mention how I like to cover things is, we go up bird's eye view first, right? We talk about what's IPS and everything. Because now when we go into details, you see a lot of like considerations, a lot of details. So next one we're talking about is investment constraints, right? What is constraining you as a portfolio manager in terms of investment? One of the things is liquidity, right? So, do we need a emergency reserve? What is your ongoing expense for your client? Are there any possible negative liquidity events like, uh, he needs emergency cash for certain things like certain usually death events that happens, usually need some kind of liquidity. And so these are considerations that you need to talk about with your client. So you talk to your client, ask your clients, do you have like a grandparents that is very old? Do you have any relatives that you're supporting in terms of medical expenses? Things like this. So you understand his liquidity requirements. And so this will impact, what's the size and the composition of portfolio, your asset base, how much must be liquid, how much can be more illiquid. So this is the command liquidity risk is the risk that of economic loss because you are not able to sell your product at optimal price, like the HDB example I gave earlier. Okay, so the level of cash you need will at any time of the portfolio. So, are there any anticipated or anticipated recurring or one-off? So these are things like you need to consider, one-off things like you need, we'll have some examples, we'll have a look at it in a bit. And do we need recurring kind of wealth, like in terms of having coupons in the bonds, etc. Liquidity, you need to consider things like what's the transaction cost. So yes, your product might be super liquid, very easy to sell, but when you sell and buy and sell more and more, you're actually incurring a lot of transaction costs. Every time you buy and sell something, you have costs, and so this will impact your returns eventually. Price volatility, if the price of a product is super volatile, goes up and down, then your product might not be so liquid, even though it can easily be sold, but you need to sell it at the optimal time, right? So the volatility of the price of a product or financial product really affects the liquidity as well. Liquidity requirements. Does a client face any short-term liquidity needs in the next 2, 3, 4, 5 years? And this is something that I like to highlight to you. A lot of the time, even for ourselves, right? Even for you and me, and when we manage our own portfolio of assets, we always like to sometimes consider, hey, you know what, the HDB that I stay or even the house that I stay in, it's actually part of my portfolio, right? But if you think about it carefully, this kind of real estate, physical real estate, is so illiquid. A lot of the times, the portfolio manager will recommend that, how about you exclude it from your portfolio? Because first of all, you always need a place to stay, right? So it's not really part of an investment, right? You cannot say that, hey, you know what, the market is doing well, I'm going to sell my house now, and I have no place to stay, and then I'm trying to find a place, rent a place or something. Unless that's your strategy, maybe your portfolio manager will agree to it, but most portfolio manager was like, no, you definitely still need a place to stay, unless you say you have a place to stay and you buy another condo or you buy private property for rental, okay, then fine, then that's part of your portfolio. But your primary residence usually is being excluded from your portfolio. That's something that you need to consider. And if your client insists on including their primary residence as in the portfolio, then you need to really ask your client why. Like, is there good reasons why you want to include primary residence in your portfolio? And of course, you need to explain to him why you shouldn't. The next investment constraint. So we have talked about first investment constraint, liquidity. The second investment constraint we like to highlight is time horizon. Of course, having talked about multi-generational planning, we know that time horizon doesn't stop upon your death, right? Because you need to consider that your kids, and then because you're planning ahead, right? So yes, most of the time people think about the investment as the day you die, maybe 10, not 10 years, but like in let's say 50 years, you're going to die in 50 years. Then you plan only until 50 years. But more and more, you need to really start thinking about multi-generational. So you don't only just end at 50, you continue to live, right? Live in the sense of leaving behind your kids. And so you plan for your kids as well. Time horizon, single versus multi-stage horizon. This is exactly what we talk about in multi-generational. So we are no longer having a one-time horizon. Oh, 50 years, I'm going to die, that's all, finish, the end. No, we need to have multi-horizon already, where, okay, fine, you're going to pass away in 50 years. And we need some expenses when you pass away, right? Because when people die, you have to plan for the funeral, and these are all expenses. Okay, fine. You need a cash outflow at 50 years when you pass away. However, you might have multi-stage because yes, you're going to leave behind your kids. Your kids might need some kind of cash flow, right? So you need to plan a second time horizon where you're supporting your kids. I mean, your wealth will support your kids for you. Of course, that's if you are a selfless person. If you're very selfish, maybe you don't care about your kids. But if you're selfless, then you plan for your kids. It's like, okay, so you want to make sure that the portfolio can support your kids for 30 years. Let's say you just want to support your kids for 30 years to make sure they're up on their feet. So in total, your time horizon becomes 50 plus 30, 80 years. So as a good portfolio manager, you should have multi-stage kind of time horizon where you ensure a cash outflow at 50 and a, let's say, monthly or yearly cash outflow for 30 years after you pass away at 50. Any questions on this time horizon? Any comments you like to add? Or maybe your personal experiences? No comments? Everyone's good? Yeah, okay. Okay, very good. Feel free to, of course, stop me anytime if you have questions. Now, tax consideration. So this is very interesting part of the IPS. Remember, still talking about IPS. So we're talking about IPS. So making sure you consider tax implications of your portfolio is very important. Why? Because different jurisdiction has different amount of tax, and maybe most of y'all do not realize, or maybe you know that actually Singapore is almost like a semi-tax haven in the sense that Singapore has very low tax, right? Of course, this is relative compared to places in the West, like where I am now in Canada. Like taxes are like crazy. Like that's what everyone talks about, right? Singapore, sometimes you take it for granted. Most of the time, eventually when you start working, or some of you are already working, know that the tax rate in Singapore for income tax is generally hovering between can be 0% if you are a student, of course, and it goes all the way up to like 25%, 28%, maybe even 30%. So if you need to research on the jurisdiction and what's the tax rates, right? And that's for income tax. And we know that in Singapore, there is no tax on dividend and capital gain, right? So your stocks or is not taxed because they are taxed at the income tax level. So these are important things that you need to consider in tax. However, let's say if your client is like Canadian client, right? His primary residence is still in Canada, then the issue comes in the point where his income is going to be taxed at, let's say, 50% because tax here is like crazy. So half of the salary is gone, right? So these are things that you need to consider. And when you think about tax, we need to consider things like residence, tax residence. So I hope some of you or maybe some of you have heard of this, where where do you consider yourself as tax resident? So this one you can simply Google. Every country has different law. So for example, in Canada, is if you stay in the country for 180 days or more, you are already considered a tax resident of Canada. So for example, you somehow you decide to move to Canada, but you're not working in Canada, you're working in Singapore, but you stay in Canada for 180 days. So the government of Canada can actually tax you already, even though your work is fully in Singapore, right? So things like this you need to consider as well for your clients. At the same time, so we talk about things like capital gain tax, property tax, wealth transfer tax. Remember, this is what we talk about when we were discussing about multi-generational planning. At the same times, we want to avoid not avoid, but we want to optimize tax by, even creating some kind of offshore trust structure here, um, to avoid. Anyone familiar with trust structures, or heard of what's a trust, or have no idea what's a trust at all? Trust fund, yeah, okay, yeah. Trust fund is very similar, yes. Trust, no idea, okay. So 1% have heard of a trust fund. Legal entity, not familiar with it. Okay, okay. So I'll just take maybe like 2 or 3 minutes to explain what's a trust. Okay. Um, it's a legal entity, that's right. No, not in a moment. Okay, perfect. Uh, let's just pull in. Okay, so what is a trust? Let's put a new picture. Okay, so how I like to think what is a trust is this. A trust is basically a structure, right? Is a like a company. Just imagine a trust is like a company. Okay. Now, how a trust work is that you okay, like okay, let's use example of me. Okay. I want to create a trust. So I create a trust like this, like a company. I create like a trust. Now, I'm going to put my money in a trust. Okay, this is my money. I put in a trust. Okay. This trust, like a company, is run by this thing called a trustee. So a trustee runs a trust, like runs meaning that it maintains the trust, like company, right? You have like managers to maintain the company, right? And like you, it's me, I'm like the shareholder, almost like that. It's the same concept of a company. So it's set up a trust like this. So a trustee basically is like the manager, and me, I put money inside this trust. Now, the trust is going to pay maybe my kids money, right? Pay my kids money every month. What happens? So my kids now is called a Benny or beneficiary. You are like call it Benny. Benny. So my money goes into this trust. The manager of the trust, which is the trustee, manage the money, and then it pays off to the Benny, which is beneficiary or my kids. Now, then it seems very simple, right? Then the question is, okay, why not why not I just pass the money to my kids like this. Why must I go through this thing, put in a trust, then the trustee manage my money, the money goes to my kids? Why not I just give the money to my kids? Anyone knows? Tax? Yeah. Guess that's the first thing people usually think about in trust. Inheritance tax, okay, bankruptcy, yeah, yeah, yeah. So you're all correct. So the main thing is, yes, do not know how to manage. That's good. That's a very good point. So the main thing is about tax optimization, right? So, cause when you create a trust, your trust is like a company. It can be incorporated in different countries, right? And the best place, not the best place, but the most optimal place to create a trust is are your tax havens, right? Your tax havens. So your tax havens are like your British Virgin Islands, your Bahamas, BVI, British Virgin Islands, uh, or even like Luxembourg. Luxembourg is an amazing place as well to create your trust. Or nowadays, also people like to do it in London, but then usually they don't incorporate in London. They create the trust in London, but London incorporate the trust in the Bahamas, let's say. So what happens is that when you incorporate your trust in those tax haven, your money that goes in are not taxed. Now, when your trust distribute money out to your kids, they're not being taxed as well because the money is being distributed from a tax haven, right? So you're not being taxed. So you actually optimize your tax. You avoid any kind of um, uh, inheritance tax, like put it. Of course, you have to pay your trustee fees, lah, right? Again, another point that is being highlighted here, which I like, is that your kids might not know how to manage money, right? Let's say you give 10 million to your kids. Wow, give so much to your kids. Maybe your kids is 18 years old. He's going to spend it on like silly things. He's not going to save it, right? So by creating a trust, you ensure that the money is being given, let's say, periodically. Let's say, okay, you're going to give your kids 100K per year only, right? And then give it for the next 50 years. So you stagger the payment. Or you can create a trust where the funds, the money that's given to your kids is only for certain purpose. Let's say only can pay university fees. So you ensure that the money is being spent in the right way, or like not right way, because there's no right or wrong, but in a optimal way that benefits your kids' future. Let's just put it this way. So you can control, first of all, the amount of payment, you can control how the payment and what type of payment is being made out of a trust. So you will gain a lot of control when you have a trust, even after your death. So yes, you might eventually die, you are gone, but the trust and your kids here, this this component here would still survive on, right? So the money still flow and everything. So you are very comfortable. You plan ahead. So this is part of portfolio management where you plan ahead for your client. So if as a portfolio manager, if you know your client has certain needs like this, you need to kind of suggest such a structure for your kids, for your clients. Okay, so there are various taxes that you need to consider. I like this idea of gift and inheritance. So I'm not sure about Singapore, but a lot of other countries, in Europe, even in the West, in Americas, what happened is that gifting tax and inheritance tax are separate things, and usually gifting tax is lower. And it can be zero if it's a donation to a foundation or something like that. So basically, the idea is that if there are differences between inheritance and gift, it's better to optimize your tax by choosing one of the options. So if gifting is more optimal, meaning lesser tax, give the wealth to your kids. Do not inherit. Okay. And, everyone knows what's the difference between inherit and give, or for you it's the same. Everyone knows the difference, inheritance and gifts. Yeah, okay, that's good. So in case you don't, inheritance is like if you die, right? Inheritance, you die already, then you get then your kids get the thing. So that's inheritance. Gift is before you die, you give. So if you are dead, you cannot give anything, right? Because you are dead. You can't give anything to your kids. So gifting must be done when you are alive. Inheritance is done after you are dead. So generally, most countries have different laws on inheritance and gift. Most of the time, it's more optimal to give rather than inherit. Of course, it depends a lot on unique circumstances. Yeah, okay, that's a good question. If in a will then got gift, so the thing is, will is linked to inheritance, right? Because will is like you die already, then the product, the assets is being inherited to your kids. Now, give means that you give before you pass away, right? So you cannot write it in a will anymore, meaning you're gifting already. So your product is gone. So let's say if you have a condo, let's use a condo example again, and then it's an investment product, right? But I want to avoid the inheritance tax when I pass away. I'm going to give the condo, give like GIFT, gift it to my kids now before I die. And so it's under my kid's name. You avoid inheritance tax altogether. So you don't need to write in the will at all because it's already gifted, right? So there's nothing to write in the will. So it's different. So as a portfolio manager, you really need to look at this kind of laws on taxes, on gift, inheritance to help optimize the distribution of wealth for your client. So there's deference and avoidance. Usually, I don't like to use the word avoidance because when we talk about tax and you say avoiding of tax is very it's like a minefield. You get to a lot of like regulatory issues, troubles like with the regulators and all. So usually we like to use the word optimization. We want to optimize the tax for you. We're not teaching you how to avoid, to optimize. You might have some knowledge of law. Yes, you do. You need to know how to read legal documents. Deference. So deference is a very good strategy. Remember, we talked about the condo thing. Remember the condo? You get the condo under your kid's name. So you kind of avoid or you defer the tax, right? Of course, you can only defer one generation, right? So when eventually, if you die and you bought the condo under your kid's name and your kids pass away and they have their own kids, then they have no choice but to have inheritance tax and whatever, right? You can only skip one generation. So usually it's a single generation skipping. Of course, if you live long enough for multi-generational skipping, that's possible, meaning that you buy a product or buy an asset for your kids' kid, right? So for example, you have grandkids, you buy it for your grandkids. You don't even buy for kids. You don't care about kids because you are more interested in your grandkids, right? Making sure your grandkids uh, have a stable life, let's just say. So that's a better strategy, right? If you're a portfolio manager, you know that your client has grandkids, buy the investment for your grandkids. Don't care about your kids, right? Because your kids are probably what 30 years old, 40 years old. They are stable already. You don't care. You just buy for your grandkids. So you defer the tax even more. So avoidance, there are a lot of this kind of special accounts, I would say even CPF account, CPF investment account that give you a lot of tax exemption, which you need to be very familiar with as a portfolio manager to help optimize. Tax strategy, you can reduce tax. Um, so it depends on what's the tax rate, right? The income tax versus capital gain. So if it's capital gains is less, then you must make sure all your investment product is categorized as capital gains, right? Uh, Tax strategy, there's a lot of things for tax strategy. Just now I mentioned early gifting is one of them. Assets transfer to kids to avoid tax, so or even transfer directly to grandchildren. So you skip generations. That's what we have talked about. Um, and some additional tax issue, things like stability of the tax code. Because as the tax code change, you need to make sure that it's stable. That's why we think about the trust structure. I hope that when you draft your IPS, think about trust structure, right? Usually, tax haven have very stable tax code. So if you put things in a trust in a tax haven, you kind of know that the tax code will be there and it's going to be fixed, right? Unlike a lot of countries where the tax code keep changing here and there, even in Singapore, it keeps on changing. Of course, unintended consequence of transferring large amount of money to young people. Okay, so let's take a quick maybe 6 minutes break. We'll be back at 8:15. And then we try to wrap up today's lecture. Okay. Again, quick reminder, remember to form your groups, send email to me after the end of this class. If not, we'll be just do a random allocation. All right, welcome back to the last part of the lecture. There's a good question. I think someone messaged me. When you do cases, and the country that you're considering your case is very important. So most of the time, the case would say. However, if they do not say, try to read the case carefully to see where is it originating. So is it in Canada? Is it in Singapore? Right? Because where you set your case actually impacts a lot of things, right? Your legal considerations, your tax considerations, what's the percentage of income tax that are being taxed, right? So imagine the case is in Canada, like where I am now. You know, you need to consider tax that is almost like 50%, right? So you need to advise your client accordingly. You cannot, you shouldn't be using the Singapore tax rate of like 70% for corporates. So yeah, these are important considerations. So in case the case does not say anything, like it's totally absence of where the case should be set, then you must try to write some assumptions, right? So you assuming that it's in Singapore, then you explain your answer. But our advice to really read carefully to see where the case is being set before making any assumptions. Okay. All right. So the last, second last is legal and regulatory. So legal considerations, need to think about any regulations on assets or bonds or buying foreign bonds, because a lot of times we talk about things like S&P 500. Those are all American kind of products, right? So are there any regulations or prevents you from buying this kind of products, right? Um, so for legal side, just now I kind of already explained the trust structure. So I'll not be explaining the trust structure again and how it actually works. So the trust structure really helps in terms of distributing wealth. But at the same time, the important thing about trust is that you're not giving money immediately to your kids, right? You are actually having a trust to do it for you, and because of that, you have more control on the how the cash is being given. Um, so a portfolio manager can be employed as a trustee. Remember, like I told you, a trustee is like the manager of the trust, to act in certain fiduciary kind of duties. There are two kind of trust. Okay, this is the part I didn't mention earlier. But I want to highlight to you there's the revocable and irrevocable trust. And it really based on the issue of control of the trust. So what does it mean? So there's a good explanation of it here. So I'll not go through every single line items, but I just want to explain to you the concept of it so you can understand, right? You can go to the details when you read through the slides again. So a revocable trust basically means that the trust can be changed. Okay, so you would think like, okay, that's quite good, right? You can change it. So I created this trust, right? And then I can change the trust anytime. However, you need to really think that whenever you change the trust, it will be based on the prevailing tax rate, prevailing legal environment that the trust is now being placed when it's being changed, right? And because of that, sometimes maybe the tax rate has increased dramatically. Maybe let's say in Singapore, from 20%, it has increased to 40%. And if you have a revocable trust and you're going to change the trust structure now, where it's 40%, meaning that your assets that you have put in the trust will suddenly be taxed so much. So it's not so good for revocable trust. Of course, it means that you can amend, changes. If you change your mind, maybe suddenly you don't want to give your kids so much money anymore because you are not happy with them. Yeah, you can change it. So it's good. So it's whenever there's positive, there's always a downside to things. There's no free lunch in finance, right? Typically, even for revocable trust, when the grantor, meaning the person who created the trust, dies, you no longer can amend the trust. Irrevocable trust means that it is fixed and cannot be revoked or changed. So this is good, especially when you are. So this is very useful when you're actually using multi-generational skipping. Means what? You are actually giving your wealth to your grandkids. Now, what happens here? When you give your grandkids, right, you create a trust for your grandkids. maybe when you pass away already, your kids are not happy. It's like, why my parents did not even give me any money? Why did not inherit any money to me, right? So they become unhappy. And usually because of this, they have family disputes, they're fighting over for the cash. But if you put in an irrevocable trust, and of course your trust is in Cayman Islands, it's not even in Singapore, your kids cannot get the money, right? Regardless of how they want to fight and do whatever things. So an irrevocable trust is actually quite good in such cases to avoid any disagreements upon death. Of course, nowadays there's this thing of hybrid structure, get best of both worlds, but it really depends on the legal law. Okay. Now, this part about beneficiary and remainder man. So what happens? Let's say you create a trust for your kids, right? Your kids. Okay, so your kids benefit from the trust. Sometimes the trust can be a perpetual trust. What's a perpetual trust? It means the trust doesn't stop. It just keeps on going and going. That means it's only distributing returns on the trust to the beneficiary of kids. So that means the assets that you put in the trust will never depreciate. It just keeps on distributing only the returns. In such trust, perpetual trust, when your kids, which is the original beneficiary of trust, um, dies, pass away, become old, the your grandkids are the one that will inherit the trust, right? So as a portfolio manager, we need to consider this. Is this going to be a perpetual trust? If so, we need to ensure that do you want to distribute the remaining asset to the remainder man, which is like your kids, or do you want to ensure that it's perpetual? So distribute the trust assets, meaning what? You sell off the trust assets and you disband the trust, or do you want to just keep on having the trust forever? So these are things you need to think about. Of course, the remainder man is pretty good because you have a long time horizon. And we know if it's a long time horizon, we can take on more risk. Risk ability is high. When risk ability is high, you can go for very high risk products, high returns as well. Last but not least, we need to consider things like unique circumstances. For example, you only want to invest in ESG products. You don't want certain sin stocks. So sin stocks include like things like alcohol. You don't want any investment in alcohol. You don't want any investment in tobacco. You don't want any investment in logging, cutting of trees, these kind of things, right? So there's some kind of unique circumstances here that you want. Okay, so we have covered actually quite a lot. What have we covered? We have covered the investment policy statement. So it's a quick overview. Investment policy statement. We have covered the objective, return objective, your risk tolerance, which is broken down into two components. Anyone recall what is it? Your risk tolerance is broken down into two parts. Thank you. Thank you. That's right. And then we cover all the small components of that we need to consider as constraints to your IPS, right? Investment policy statement. And hopefully an investment policy statement will allow you to achieve all these things, right? And consider all these government issues, which this one will cover in the next lecture. Okay, so unfortunately we are still not done, but just hold on for a little more. I know it's a bit late already in Singapore. So we have talked a lot about the IPS, right? Now, the question is, so who are our clients? Because yes, we have a broad overview of the IPS, what needs to be considered. We have all the factors, again, I repeat, whenever you do a case, you must do an IPS, you must do an IPS. So yes, you crafted IPS, but what's important is you take a step back, right? Understand first, who's your client? Is it an individual? individual, a very rich individual, or we like to call it high net worth individual? Is it a family office? So what's a family office? Family office is basically a very wealthy family, and because they have so much wealth, you in layman terms, you need a office to manage their wealth, like a literal kind of like a company to manage wealth for them. So like family office. That's how you can think about it. So do you need is it a family office? These two are still kind of similar, right? They are individuals. What's a different kind of management, advisory versus discretionary. Um, this one this one actually should be linked to, or you should think about it in terms of what is your client's willingness to take risk, right? So if your client is not so willing, maybe or your client is a self-made investor, right? Self-made. Remember, if you recall what self-made means that he's an entrepreneur, he really get the wealth through taking risks. Then maybe you want to do more of an advisory management. Advisory means that you just advise him, but at the end, he makes his own decision, right? However, if your client is more of an inherited kind of wealth, maybe you want to do more discretionary, right? Discretionary meaning that you help him plan the portfolio, help him execute a portfolio based on his requirements, right? So those two things, high net worth and family office, are kind of what we have been talking about. But I want to highlight to you that, hey, you know what? As a portfolio manager, your clients need not be individuals. It need not be a rich family. It need not be a rich individual. They can be things like a pension fund, an institution, and we'll look at foundations, charities. So even this kind of organization or endowments, right? That means like endowments meaning from like schools and all, they can actually approach you as a portfolio manager as well. And their requirements are very different from individuals. Because remember, when individuals, which is most of what the lecture we kind of reference to, it's like things we need to talk about income tax, capital gain tax. Those are very related individual. But if you are a organization, if you are a pension fund, you are being treated very differently, right? So in this example here, a pension fund. So I want to explain the idea of pension fund because in Singapore, the idea of pension fund is basically just a CPF, right? But the Singapore pension or the CPF is very unique to Singapore and it's unlike most of what we think about in the West when we talk about pension funds in the West. However, there are some similarities as well. So the idea of pension fund, which has been demolished in Singapore way back, maybe your grandparents might still benefit from some pension, even though I think most do not anymore. The idea of pension fund is that you put money in this account, right? Pension fund is you put money in this account when you're working. Now, when you eventually retire, this pool of money that you have put inside will start distributing money to you every year or every month or every year, depends on how it's been structured. So that's how a pension fund works. And usually it gives you not only your money, it gives you like a fixed amount. So depend on the plan. So is it a defined benefit plan or defined contribution plan? So how they distribute money to you depends on the plan, right? Is it a benefit or contribution plan? So this is very unique to the West because in Singapore, the CPF, as some of y'all who are working already know, it's like it's just your own money. Then you can use the money to invest here and there. It's like a pension fund, but it's not going to distribute money until you die. Even though there's some nowadays, there's some types of CPF or some types of investment you put inside, it can distribute till you die. It's getting closer to more pension fund, but in the West, most pension funds are like this that we discuss here in this module, which is a defined benefit, a defined contribution. So this is a description here, but I like to use the table here to actually explain to you the difference, right? The comparison defined benefit, DB, defined benefit, or DC, defined contribution. As the name suggests, defined benefit. So what does defined benefit mean? This one? Okay, for the employer, what it means is that you're going to define the benefit that you are giving your employees. So it means that the benefit is being determined and the criteria is stated when you are being employed. So this is defined for you as a employee. The employer is going to define for you. Okay. And then the plan sponsor, which is the employer, right, is responsible for managing the plan and meeting the pension obligations. All right. So this is the defined benefit. But defined contribution, on the other hand, is that the employer will promise to keep all contributions at current. Okay, fine. The employer only just give the money to the employee, right? He just give the money to the employee. The employee kind of make his own determination on what he want to invest in, right? The only financial liability is making the contribution to the employee. So the employer just give the money to the employee. That's all. Finish. The employer doesn't do anything else, right? For defined contribution. So that's what is being described. Defined contribution. So it only defines the contribution the employer needs to make. Now, on the employee side, since we are talking about defined contribution, let's talk about this first. Defined contribution. The employee makes his own assessment. He chooses what he wants to invest in and bears all risks and rewards and requirements in the portfolio. Okay, so this is quite similar to our CPF. Oops, what am I writing? CPF. Yeah, it's very similar, but it's not the same, right, as CPF. Now, the defined benefit for employee, you and me, is that he'll just receive the promised payment. So, for example, he works in, let's just say SIA gives defined benefit plan. So, when you are retired from SIA, it's really right in my employment contract that I will just get 100K per year, and the employee basically just receive whatever is being promised. That's all. He don't need to do anything. Yeah, the employer too pays you after you retire. That's right. So the risk considerations for a defined benefit plan is very different from a defined contribution plan. So we need to consider the risk considerations in terms of what's the financial status, the profitability of the sponsor, what's the correlation of the assets and the business. So for example, if the sponsor is SIA, what assets did it invest in for the defined benefit? Right, remember, defined benefit means that the employer to pay, right? So the important thing you need to consider is your employer, let's say it's SIA, should not become bankrupt, right? If your SIA become bankrupt, disappear, it declare bankrupt and become no longer a company, of course you can't get your pension anymore, right? So you need to make sure the financial status, profitability, the correlation, the asset. So, what's the plan features? Are there liquid assets that your SIA is investing in, right? What is your employee retirement split? Meaning, what's the workforce like? Are there a lot of young employees? Are there a lot of old employees? But if there are a lot of old employees, it means that a lot of them are going to claim on their pension soon, right? What's the time horizon? How old are your employees, right? So I have a question here. How the employer sustains such payment? Okay, that's a good question. So this is because Singapore do not have this kind of pension plan, you don't really see this. But if once you look into foreign companies, okay, let's say we have okay, so there's something like SMRT in Canada, right? SMRT meaning the transportation company that does the trade, right? Like in Singapore, there's something similar here in Canada. So the thing is, because Canada uses the pension system, what happens is that usually such big government organization has a separate arm simply to manage the pension funds, and those are portfolio managers. And so, as an employee of this, let's say I'm an employee of SMRT in Canada that has the pension thing. As an employee, I'll be very concerned about what SMRT's pension arm is doing with the money, right? That's why you need to assess things like, hey, you know what? What is the financial status of SMRT? Because let's say SMRT is having the pension. What is the asset that they invest in? So you need to really assess the company's pension arm financials, or how are you doing, right? So usually that's how it's set up. For most foreign companies, they have a separate subsidiary, a separate arm that does and manages the pension. And usually people there are the portfolio managers, and they have these considerations here. So how does employer sustain payment? Of course, the employer must be profitable. It cannot be losing money. If it's keep on losing money, it's going to be bankrupt soon. Then I guess your pension is gone. So that's why, overseas, whenever a company goes bankrupt, there's a lot of ramifications for uh, employees, because they lose their pension, right? That's why a lot of the protests, because especially for people that work there for 20, 30 years, and then let's say a company just go bankrupt, then all their pension savings is gone. So that's why Singapore system is very different, which is, I guess, a lot better. Because imagine you are working in, let's say, SIA for 30 years, and your pension is all in SIA, right? SIA is managing your defined benefit plan for you. And let's say after that, suddenly SIA just go bankrupt when you're going to retire, then all your money is gone. So you have no, if you have no external saving, all your money is gone, right? Yeah, manager, but a bit too late, right? So you need to assess, even as an individual, you need to assess the manager whether he's doing well or not. So how do you assess whether it's doing well? We need to consider the present value of the planned assets versus the present value of the future liability. So your future liabilities, of course, is your pension payments, right? Payments. How much what's your cash outflow? So basically you're considering cash, your asset that you have versus your cash outflow, your present value of cash outflows. So we have various status: fully funded, overfunded, underfunded. You can just read it. Basically, fully funded is the best lah. You have enough, your asset covers your present value of liabilities. Overfunded means that you have more, underfunded is usually bad. Uh, and your IPS for your defined benefit plans are quite different, right? Because your return requirements would therefore be to meet or to maintain certain status. Like if you are funded status, you want to maintain your funded status, right? Your risk requirements could be very different as well. If you are already a fully funded pension, maybe you can take on more risks, right? You're fully funded. However, if you're underfunded, then you need to consider reducing risk so that you ensure that you improve your funding status. Liquidity really depends on your how many employees are going to retire soon, what is the cash outflow, are your employees very old, are they all going to retire, and then you need a large sum of money that is going to outflow in the next 50 years. Time horizon, yeah, characteristics, how often are there a lot of young force that's going to contribute to the pension, legal status, and unique circumstances, right? Motivation, etc. So if you look at it, we're talking exactly about the same aspect, right? The IPS that we talked about: tax, horizon, legal, unique. So remember, you need to really mention every single component of IPS, regardless of what you are assessing, whether it's an individual, whether it's a institution, like a pension. Defined contribution. So we explained the difference already. So contribution is just you contribute money, right? And so there are also some criteria such as the ERISA, which provides some guidelines. So a lot of the thing about pension is that it's very highly regulated, because it really is the employees' retirement money, right? So that's why a lot of people want strong regulation on pensions. At this moment, I will not go through this case study. You can read through because the answers are provided. But I want to highlight that this case study is important in understanding pensions. And it really helps you understand the aspect that you consider. Okay, so I'll just move on to the content. And we have quite a lot of discussion here on the case studies. The solutions are fully provided. So this case study is about pension. Now, besides pension, there are other clients that we are quite interested in. So it includes foundation. So we're going to consider what's the difference between a foundation and an endowment. Now, a foundation, as some of you all would have known, or even is active in some certain foundations in Singapore, especially a lot of race-related foundation or religious-related foundation. They are typically constructed by a gift or investment asset by usually a single donor. That's how a foundation happens or is created, right? And most foundations are private, and they generate the entire grant-making operational budget for their portfolio. They're subjected to some kind of minimum spending that's required here. Now, endowments, on the other hand, are more related to like school, museums, hospitals. So these are like probably like university, all university has like somehow endowment fund or something like that, an organization related to charity activities. So they are generally constructed by a portfolio of like gifts, assets, and it's built up over time by many individuals. This is the difference. It's like usually many individuals build up this whole endowment, right? And then the spending is distributed based on like things like for schools like scholarship, to pay instructors, to maintain the buildings, upgrade the buildings, etc. So usually endowments face no minimum level of spending requirements. So this is the highlight that foundations and endowments typically have the same IPS. So remember, at the end of the day, we are still talking about IPS, but we are talking about the different clients. And so for endowments and for foundations, the IPS is kind of identical in terms of objective, strains, risks, returns, etc. So at this point in time, this is a small sidetrack. I want to highlight to you that I'm not sure if all of you or anyone know that anyone know about Rolex, this company Rolex? Yes. So is Rolex a company? Anyone knows? Is Rolex a company? Yeah. Oh, somewhere no, it's a foundation. That's right. Rolex is actually a foundation. Yes, expensive watch. But if you dive in the detail of Rolex, right, and you read about more of the company structure and this kind of thing, it's actually a foundation, which is very interesting. And because it's a family run, I mean, not family run, but now it's not family run, but it's like it started as a family business. They actually created a foundation, and a foundation is actually one way, right, to optimize tax also. Because it is not a company, it's not subjected to tax, right? And usually there are tax incentive for foundations. So very interesting. If you dive into YouTube, if you Google Rolex Foundation, you can really understand a lot of the darker sides of how you optimize wealth, right? Because at the end of the day, Rolex is a family business. They are trying to optimize their wealth. So it is a foundation. So yeah, there's an interesting YouTube on it. Okay, so risk considerations for foundation and endowments. So objective generally is to cover spending, inflation, and some management costs, because foundations require management as well. Yeah, yeah. So part of the reason is to evade tax, but like I mentioned, right, whenever you okay, if you are um, working and not really when you're working, but in this discussion about portfolio management, taxes and all, we usually do not like to say evade. Yes, it's evading, but it's more optimizing your tax, right? So yes, it is to optimize tax for the founders of the foundation. So usually the portfolio is perpetual. So it's a perpetual um, uh, portfolio and pursue usually ability to pursue very high risk because it's forever, high returns as well, no contractual future obligations, entity may not solicit new funds, etc. So there are some risk considerations in a foundation, and usually foundation, the good thing is intergenerational or multi-generation as well, because that is perpetual, right? Of course, there are some requirements. There's some minimum distribution requirements that is typically being enforced. There's some legal and regulatory requirements as well. So yes, when we think about foundations or like the Rolex Foundation trying to optimize their taxes, it's good, but there are also some regulation requirements, reporting requirements that they have to meet in order to be a foundation. So not everyone can just become a foundation, right? So there's some kind of requirements. See, so just now you mentioned about tax. So the typical IPS for foundations is that they are tax exempt as long as they meet certain distribution requirements. So there is some requirements where, if I'm not wrong, Rolex have to distribute certain wealth to charities or something like that. So they do have to go through some legal regulatory requirements, but then they can become a foundation, right? So yes, there's some requirements here. Yes, there is a so in your law, there's corporate tax law, there's charity law, there's foundation and even endowment law. Yeah, to start. Yes, there is. If you are interested in the legal aspect of it, it's a totally different ball game. And of course, it's very country specific as well. Primary objective is to earn a rate of returns, including the spending, inflation, and management fees. Right. So you want to, of course, cover all your fees because you're not a company, right? You're not making profit, right? If you take the traditional sense of foundation, you're not like investing in products making profit. So we basically cover our expenses, distribute any of the wealth. Liquidity needs are usually low except for any planned capex. So capex is capital expenditure. This includes things like upgrading of buildings. So you upgrade buildings, by the way, upgrading of buildings, or certain equipments, mm, uniqueness. So a lot of the foundations and endowments mm, generally have certain mandates to maintain. For example, there was a recent push in a lot of college college or university endowments to avoid or not avoid but to reduce their exposure to coal meaning the thing that you burn, the black stuff, right? Because they are not ESG compliant. So a lot, I think there was article like a couple of years ago or just 2 or 3 years ago about NUS or even NTU's endowment that has a lot of coal investment. So there's a push for them to divest the coal investment in the endowments. So there are things like this, right? Some uniqueness to endowments and foundation that because they are foundation endowment, there's some regulatory requirements reporting, and therefore they are not private companies, right? Meaning private meaning that you can't see what's their financials. It needs to be published and everything. So there's a lot of criticism whenever certain things are flagged out, like the example of co-investment in endowments in NTU and NUS. ESG. So ESG stands for environmental, social, and governance. So basically, they are like the green stuff, right? That a lot of people are now focused on. So E for environment, S for social and governance investing. So generally, ESG investment means that you want to avoid things like coal, logging, like cutting of trees, because these are not green stuff. Okay. So there is another case study which I will not go through. I highly recommend for you to read through it because the answers are provided. And it goes through every single step of the IPS that's required to be drafted. So this is a good example of how you should tackle each step of the IPS, right? And explain your selection. Okay, I highly recommend for you to look through this. Now, last but not least, we'll talk about our clients, which is, so we have covered individuals, we have covered institutions, foundations, endowments, which are kind of similar in terms of IPS. Now, last but not least, we talk about insurance. So insurance companies, they also require some kind of portfolio management, right? To manage the assets. And we classify insurance into two key categories: life insurance and non-life insurance. So at this point, I want to highlight I'm not an insurance agent. So nowadays there are a lot of products, a lot of complexity in insurance, and increasingly there are like university courses just specific to insurance, and they usually call actuarial science. I'm not sure if some of you heard actuarial science. So it's really geared towards insurance. However, the broad idea is that there are two kinds: life and non-life. Life is things that you invest. So you put the money in the insurance product, and then this product grow and gives you certain returns, almost like a pension, right, for life. Non-life is casualties. For example, you have a accident insurance, hospitalization insurance. So those are more like casualty-related kind of insurance. You get kind of returns upon certain event that happens. I want to highlight that insurance products are actually very good portfolio products. So whenever I think about portfolio products, right, do not only think about stocks, bonds, real estate. Yes, these are very traditional products. Fixed deposit. So these are very traditional products. But think insurance as a portfolio product as well, because it protects your portfolio. Maybe you buy insurance for downside risk. Downside risk meaning what? If a portfolio drops in certain amount, you get certain return. And of course, that kind of insurance is called derivative products that we talk about in the option, when somebody mentioned options. So that is kind of like insurance products, right? A derivative products insurance. But you can actually buy physical insurance products like life insurance products, where we discuss should you will HDB to your two kids, right? So remember I give the example, how about you buy life insurance investment product instead, and you will the HDB to your one kid, give the insurance product to their kid. So I want to challenge you to think about insurance as a product to include in your portfolio. Okay. And yes, unlimited risks, that depends. We'll go in depth on derivative products in lecture 3, and I really like that topic because there's so many flexibility and so many things you can do using derivatives. But let's wait to lecture 3 to discuss that. All right, so for life insurance considerations, again, we are still talking about the IPS. I want to highlight this again. Is that you need to value, what's the risk, what's the credit risk. In terms of the cash outflow, which the main thing is that they are generally quite predictable, right? You know that when the life insurance policy approaches maturity, the policy holder is going to take out the money or going to get some payouts, right? Reinvestment risk, they don't take risk that will impair the policy holder. And insurance companies are highly regulated because they are almost like a trust fund. Okay, so this is in comparison with the so this is the IPS of a life insurance. So in terms of return, you need to meet the minimum requirements of the policy holder, meaning that if there's a payout, you must be able to pay out, right? So there's a capital adequacy requirement because it's regulated by government. Usually that you need to maintain a certain amount of capital. Capital meaning like liquid assets, tier 1 capital. Total requirement is usually measured in returns, risk, overall risk tolerance account low. So these are some example of IPS. Again, the time horizon, life insurance depends on your clients. It can be long, it can be short, depending on your profile of clients, right? Are they approaching the payout period of the life insurance? Tax, very complex. So there is a whole course on tax for insurance. Liquidity, what's important is to ensure asset liability matching, or mismatch is where there's a mismatch in asset liability, and this will cause usually a lot of issues. And what does this mean? It means that you must have enough, in layman terms, you must have enough assets, liquid assets, when the payout is required, right? So you need to ensure good matching of your assets and liability. And not only that, when you match assets and liability, you need to match the tenor. So it's tenor meaning the how long the assets will last, right? So you need to match the tenor of the asset with the tenor of the liability. So what does this mean? It means that your bonds has a period like 10 years bond, 20 years bond. So you need to make sure that the bond period is matched to the liability period for the insurance. Liability meaning the payout, right? So you need to match the cash flows. So these are things that you need to consider for life insurance. Legal, extremely complex, a lot of regulation, very similar to banks, like what you mentioned. Unique, so they are very large. They usually have some unique, nowadays a lot of companies are into ESG components, so they like to promote their ESG insurance investments. In terms of non-life insurance, now non-life, remember, is about casualties, is about hospitalization. So these kind of things, usually the cash flows are generally more erratic and unpredictable because you don't know when the person will have a accident and needs the payout, right? So you need to make sure that you have enough liquid cash. You cannot take so much risk. Overall risk tolerance is still low. Yes, you can invest surplus aggressively, but you must make sure that you have enough liquidity when the requirement to pay out is requested. So some considerations, again, time horizon generally shorter, but may include long tail. What's a long tail? Meaning what? Because sometimes your hospitalization, you can buy the insurance products. Maybe now some of your friends might be approaching you to buy some medical insurance or hospitalization insurance, right? But chances are, given that you are in your mid-20s, early 20s, you never need to use the hospitalization insurance until 30 years later. So because of that, you have a long tail. That's why you call it a long tail for your non-life insurance, because you will not ever claim, or not ever, but unlikely to claim it, right? And because you have a long tail, that's where your insurance company make money, because you're going to pay your premium for 30 years before you even use it. So maybe by the time you pay for 30 years, right, that they will recover the sum of whatever claim you're going to make later. So that's how insurance companies make money. But so yeah, tax is quite complex. Liquidity, again, you need to focus on ensuring asset liability matching in terms of the tenor. Regulatory, very highly regulated and complex. Okay, so this is a summary of insurance, the differences. Last but not least, we have banks. So banks, commercial banks, they investment banks, they all also need portfolio managers. That's why there's actually quite a lot of jobs going around if you are interested to be a portfolio manager. The good thing about banks is that they are able to manage the risk themselves because they are intermediary, financial intermediary, right? So, they are able to, we quite hedge the risk. Hedge meaning what? If you take on a lot of certain risks, you are able to buy another product which balances the risk. So that's hedging, right? So you balance the risk. So banks are able to do that. They are very unique in that sense because they are a financial intermediary as well. So security portfolio plays an important part on the bank risk and liquidity position. So not too much on banks. So this is just a summary of the general, I would say general components of the risk tolerance, time horizon, liquidity, income needs for the various clients that we talked about. All right, so I think we're out of time, and this is actually just where I want to stop. Just to do a quick wrap up, right? So in today's lecture, we really just drill down and focus on the IPS, right? IPS, hopefully now you know what IPS means, is investment policy statement. We really drill down in the details. And again, I want to highlight that in any case, in any kind of discussion on portfolio management, you have to talk about IPS. You have to talk about every single component and discuss them in quite detail, right? Before you talk about everything else, because a question might be asking you about something else, but you need to first have a base on the IPS, craft the IPS, then you talk about whatever they want to ask you about. Okay. And we have to go into quite a lot of detail as we have discussed in the lecture because we have considered a lot of things. And that's what we are focused on. Of course, the last part of the lecture was more focused on who are our clients, because different clients have different needs. At the first start of the lecture, we really focus more on like individuals, but then eventually we realized, you know what, your clients can be institutions, it can be banks, it can be insurance companies, etc. So that's all I have. There is 2 mandatory readings to be done. So one on ESG investing. So the ESG investing review our own unit 1. So I have done the slides for this. So if you do not want to review the study guide, just review the slides here. There are all the information required. Just more like reading. Again, you don't have to memorize anything. Just more understanding the content. Feel free to ask me or drop me any questions if you do have it. Last but not least, there is also a second mandatory reading is on the CFA Code of Ethics. So because our program for portfolio management is very closely related to CFA, actually level 3. So if any of you are taking CFA level 3, this will be very useful as well. And also for the Code of Ethics, it relates to CFA level 1. So there is some self-review. I've given you the 6.1. So it's just, you can just look through, it's just some readings on the code of ethics that need to be respected as a portfolio manager in general. All right. And the last but not least, I'm sorry, there's quite a few things. And last but not least, there will be a lecture posted called Lecture 2A that you are required to watch before Lecture 2. All right. So before the next lecture, please watch Lecture 2A because Lecture 2A is a recap of what was covered in previous courses, which I find that is quite important because when the first time I taught the course, I just jumped into the Lecture 2, the actual Lecture 2, but then there are a lot of gaps that we need to fill, and then I realized that a lot of people don't understand the past concepts. So I did a Lecture 2A, which explained those concepts and includes one case study. And then we'll dive straight into Lecture 2B in the next lecture. So all the lectures will be posted in our tutorial 3 under the module. So in the tab that's called module, where you find your lecture slides, I'll post probably tomorrow the Lecture 2B inside, where you can watch it. So you can download the recording. I'll post this lecture's recording there as well in our tutorial 3 module tab. Okay, let me pause the record.